Good evening, students. Welcome to this session for Paper 6, Integrated Business Solutions for final course under the new scheme of education and training. In this session, we'll be taking the case studies on integrated business solutions. I am CA Shefali Jain. I am a faculty for Indirect Tax Laws. And today with me, I have faculty for other subjects also who will be joining us during the course of session. We have with us CA Shilpa Agarwal, who takes the subject of financial reporting. Shilpa
Hello,
ma'am.
everyone.
Yeah. And we will, other faculties will be joining us during the course of the session for other subjects.
Okay.
Yeah, we have, so they have joined. I think there is some technical issue at their end. So we'll be taking the integrated business solution case study. As you know that these sessions are specially dedicated for apprising the students how to approach the case studies, and in each session one case study or is taken and it is explained to the students. All the aspects of that case study is explained to you. So should we start?
Sorry, Shefali. Before starting with case study, I would just like to request you to brief students because though we have already covered in our first two sessions how to prepare for this paper, what should be the approach, but still students are facing some difficulties and they are again asking to brief again. So may I request you to just throw some light on these aspects, and then we can start with case study.
Okay, ma'am. So we'll first of all have a brief idea about the IBS paper, how to approach this paper, and how much time duration is there for the paper, what all study material we have to refer, what we have to take for the examination because it's an open book paper. So we'll first, once again brief that, and then we can start the case study. So in fact, integrated business solution is a very important paper which has been introduced under the new scheme of education and training, which is going to be effective from May 2024 examination onwards. Because in today's scenario, the role of a chartered accountant is undergoing a significant change. Chartered accountants are assuming newer responsibilities. So there has been a marked shift towards the strategic decision making. Earlier, the role of a chartered accountant was more towards the record maintenance, auditing, taxation, and financial management. But these days, they are also being considered as they are also being involved in the decision making of the business. So their role is constantly evolving, and so do our course curriculum is also evolving in the similar manner. So therefore, we have to develop our chartered accountants in such a manner that they can be a complete business solution provider. Because how a chartered accountant is perceived by a business always expects a chartered accountant to provide him solutions for every financial problem, every taxation and auditing problem which comes in the course of his business. So at the final level, you gave in-depth understanding of each paper separately, or individually you study each and every paper. But in business, in real world, the businesses don't operate in silos. Every decision which is taken in one area of the business will always he has or which he possesses in the field of financial reporting, financial management, then auditing, the tax laws, indirect and direct tax laws, and the law paper, then subject of law, strategic cost and financial, strategic cost and performance evaluation. So therefore, everything he has to apply in an integrated manner. So there should be testing on the same for the students also. The students need to follow a multidisciplinary approach while approaching this paper. Because when they actually solve their real life scenarios or case studies based on real life scenarios, they get to know that how they are actually going to apply when they qualify as a chartered accountant, and then they face these situations or challenges in the real world. So you yourself can understand that how important this paper is. It will definitely increase the credibility and employability of the chartered accountants. So therefore, you all should take this paper very seriously, and this paper is very, very important paper which has been introduced in the chartered accountancy course. It encourages the understanding of different business aspects of the company or the organization. And the chartered accountants should know that how they need to collaborate or how they need to interact with various professionals, various domains of the organization while taking a particular decision. Chartered accountants often perform versatile roles in the organizations, and therefore they need a multidisciplinary approach for solving these problems. This paper will be tested through a multidisciplinary case study with strategic management. All the areas, all the core papers of the CA course or Chartered Accountancy course, which are being tested at the final level, namely financial reporting, advanced financial management, then auditing and assurance, direct tax laws and international taxation, indirect tax laws will be tested in this paper. Apart from this, these two self-paced modules of self-paced module of set A, that is corporate and economic laws, and set B, strategic cost and performance management. So these subjects will be tested in this paper. You need to assimilate the knowledge which you have gathered in these papers for answering the case study, which will be tested in the examination. So primarily you have to focus on the core papers while preparing for the examination. So be very thorough with your concepts in the core papers, namely financial reporting, auditing, taxation, and financial management. The objective of this paper is to analyze and integrate the concepts, principles, and provisions of accounting, auditing, taxation, corporate laws, finance, and business strategy and management to address the issues in practical case scenarios, because the objective of applying and integrating the concepts which you have learned in these subjects is to address the practical case scenarios. Whatever situations you face in practical world, that you should know how you are going to face those problems. And this paper will be very helpful in your real life situations. When you qualify as a chartered accountant, when you go into the industry, you will definitely find whatever integrated application of provisions you have learned in this paper that will be very useful at that time. So this paper is very, very important, and we all need to appreciate that yes, this paper will definitely help us in increasing or enhancing our employability in the job market. And one important point is that this paper is a 4 hours paper. This because all other papers are duration of all other papers is 3 hours. But for this paper, duration will be 4 hours. So extra 1 hour is given to you because it is an open book, multidisciplinary case study based paper. You will be given 5 case studies in the examination. In the question paper, there will be 5 case studies, out of which you have to attempt any 4 case studies. Further, because some students have this apprehension also in mind that this paper will be difficult. But those students who feel that this paper will be difficult to qualify, for them, I will tell you that you will definitely perform well in this paper. Only thing that you should be thorough in your concepts and you should know how to approach the paper. You have to have an integrated application of all the provisions. That is what is required in this paper. So 5 case studies will be there, out of which in each case study, there will be 10 marks dedicated to the MCQs, multiple choice questions. So, and every MCQ will be a 2-marker MCQ. The MCQ will be an application and analysis based MCQ. It will not be a direct question. All answers to the MCQs will arise from the case study. So there will be a case study which will be provided to you. After that, there will be 5 2-marker MCQs which will be given. This is the paper pattern which I am telling you, so that when you go in the examination, you should know that yes, which strategy you have to adopt for answering the questions. You have ample number of case studies also, and you will be getting more case studies in this mock test papers. Already revision test papers, journal, and through websites, the case studies have been posted. 15 case studies have been posted on the website, BOS Knowledge Portal for integrated business solutions. Plus 3 case studies are there in the journal, and 2 case studies are there in the revision test papers. So you will get more case studies in the mock test papers, which will be conducted shortly. So you can practice your questions or case studies through these sources. Now, each case study, as I told you, will carry 25 marks, and there will be 5 case studies in the examination. You have to attempt any 4. So you have to first of all see that which case study you have to attempt. Then each case study will have 40% marks allocated to MCQs. That means 10 marks portion will be for MCQs, and this 10 marks portion, for that there will be 5 MCQs which will be asked, and each MCQ will carry 2 marks. Then rest 60% portion, that means 15 marks, is of the descriptive questions. Now, descriptive questions may involve some computation. They may be an application or analysis based questions. Now, for example, in descriptive question, there can be three 5-marker questions. That means 3 questions, each carrying 5 marks, or there can be 2 questions, one carrying 10 marks, one carrying 5 marks, or there could be a possibility 8 plus 7. So any breakup can be there, but there will be a descriptive portion of 15 marks in each case study. That is for sure. This paper pattern has also been shared with you on the website. This has been shared by way of an announcement with all the students, because we want you to be comfortable with this paper and gain confidence that yes, you can easily attempt this paper and you can perform well in this paper through proper preparation and study. So generally 3 to 4 subjects may be tested in one case study, and there will be an integrated application of all the provisions. All the questions, MCQs or descriptive, will be application oriented, and the answers to these questions will arise from the information given in the case study. Now, another apprehension which students have in their mind is that which material we need to carry, because they feel that we have to carry a lot of material with us, and how will we be able to carry that much material in the examination. So that is a matter of concern for them. So for this, I have few suggestions, though I would always say that it depends on which area you have a strength in, which are your weak areas, and which material you feel that you should take to the examination. That depends on your preference and your choice. But our suggestion would be that since this is a second group paper, so that means you would be preparing for direct tax paper, direct tax laws, that is paper 4, direct tax laws and international taxation, and paper 5, indirect tax laws. These 2 papers you must be preparing for, and these are closed book papers. So their provisions would be more or less memorized by you. They must be retained, their attention must be there with you. So what you should do is, for them, you can refer the Saransh, or you can take to the examination hall the Saransh for the Saransh for these papers. And then, so in group 2, 2 papers, DT and IDT will be covered this way. You can take Saransh for them. That has the summarized charts, summarized diagrams for all the concepts discussed therein. And then comes the first group papers. 4 papers I am first of all taking, because as I already told you that in this paper, the case studies will be based on 4 papers for final level plus set A and set B of the self-paced modules. So in core papers, DT, IDT, you know that you will be covering in second group, and you will be learning their or retaining their concepts, their provisions, their closed book papers. So you can take their Saransh. That will give you a fair idea that to memorize or to get, recall the concepts. And then for first group, the FR financial reporting, you can refer the Saransh. You might take the Saransh of financial reporting also, because that is very comprehensively covering all the Ind AS. And for these advanced financial management, the study material has 1 module. It will be handy for you to carry. You can carry that. Auditing material you can carry. And then for self-paced modules, you can carry the material. So, but please bear in mind that this is only a suggestive list of material which I am telling you for carrying into this examination hall. You may take the material as per the areas which are your strengths or your weaknesses. Assess your areas of strength and weaknesses, and accordingly you decide the material which you want to take to the examination. But most important point here is that whatever material you are taking into the examination hall, please be conversant, be familiar with that material before the examination. While preparing, you should use that material, because in the examination hall, you should exactly know that which provision has been discussed. Only thing you need a reference of the exact rate of tax, or maybe exact period, whatever you want to refer. But so the exact provision you want to refer, but you should know the material properly, which you are taking into the examination. Now, as I already told you, that from what are the sources for practicing the case studies. The case studies are constantly being added into the case study bank. Like 15 case studies were initially hosted on the website for the reference of the students. And in fact, we are one by one discussing these case studies in these sessions, which started on 15th of January last month. These general provisions or the general guidance was there in first two sessions, was provided in first two sessions. So you can refer that also. For the students who have joined today or on the, since on every, most of the students were requesting that they need some more information regarding the IBS paper, information integrated business solution paper. So once again, I am repeating all the approach or the material, then the paper pattern for this particular paper. So 15 case studies have been hosted on web. 3 case studies are there in the students' journal for the month of February. That is the last month. 2 case studies are there in the revision test papers, and then you will get more case studies in mock test papers. So you practice these case studies which are available with you right now, and then you appear for the mock test paper under the examination like conditions. You will get to know that how comfortable you have been with the case studies. Now, so please take out any apprehension which you have in your mind that this paper might be difficult, or how will we approach this paper, or will we perform well in this paper. You will definitely perform well in this paper, because see, 40% of the paper is MCQ based. So there that will save your time on writing the detailed provision. You just have to apply the provision and ascertain the answer. BOS faculty is there to help you in each and every subject. You can ask your queries through the BOS app. Ask your query section is there in BOS app. You can ask your subject related queries from the BOS faculty. Then the subjects which you are not reading right now. That means suppose you are a second group student and you have already cleared first group earlier, or law paper and SCMP paper you have not gone through self-paced modules. Then you can go through the live learning lectures for the core papers, the live learning lectures for this financial reporting paper, auditing, then advanced financial management. They are available on the BOS app. You can go through them. This will help you in revising your concepts for these subjects. For DT and IDT also, direct tax and indirect tax laws, you can go through the lectures. You can ask the faculty your queries, whatever doubts you have in your mind. So we all are there to help you in this subject, so that you feel comfortable and you feel confident that yes, can perform well in this subject. These IBS sessions, this live learning sessions have been specifically dedicated, or they aim at familiarizing you with the way to approach these case studies. Because when you, one by one, when you start doing all the case studies, you will yourself understand, you will yourself feel that yes, you can attempt these case studies. Only thing is that you have to apply the concepts in an integrated manner or in a collective manner. You will definitely score well in the examination. How you should approach the examination. In fact, in the examination, one important point which you have to keep in mind is that when you get the question paper, you have to have a glance at all the case studies, because you need to find out that which 4 case studies out of 5 you are going to attempt. So have a glance at all the case studies, and just by reading the case study, don't judge that yes, this case study is difficult or it is easy. Go through the questions also. Have a glance at the questions also, because there can be a case where by reading the facts of the case, you might find them to be difficult, or you might get an impression that the case study is difficult. But the questions asked are the questions which you know. So go through the questions also before deciding that whether you are going to attempt that case study or not. And once you have decided the case study that which you are going to attempt, then please don't waste your time in changing the case study or flipping the case study, because that will again take a lot of time. Reading a case study actually takes time. So once you have decided that this is the case study which you are going to attempt, and for 4 case studies you have already allocated or separated that yes, these are the case studies you are going to attempt. So try to stick to that. This will help you in saving time. You have 4 hours for this paper. There's extra 1 hour which is given to you because it is the multidisciplinary case study paper. So approximately try to finish each case study in less than 1 hour, so that you get some time at the end of the paper to revise, or in case any question has been left or you feel some requirement you have misunderstood, you want to check your computations. So for that purpose, try to keep aside at least 15 to 20 minutes at the end. And before that, try to complete your case study in less than 1 hour each. 4 case studies and 4 hours are given to you. Okay. So each case study unfolds a unique business solution. It presents a complete scenario with the mission, vision, objectives of, and sometimes the data of shareholders or the information of the financial statement extracts might be given to you. And on the basis of that, you have to answer the questions which are given in the case study. Before we move further, let us see if we have any query of the students. So, Mansha is asking how to prepare for set A and set B self-paced module. Mansha, self-paced modules, if your attempt is due in May 2024, then these modules are, as of now, they are exempt. So you need not appear in self-paced modules. Only for the purpose of multidisciplinary case study, you have to go through these papers. In case any general query any of you have, then you can ask that query. Otherwise, we'll start with the case study. So I'm waiting for 1 or 2 minutes. Otherwise, I will start with the case study. And today we are going to take case study number 12, which is posted on the website. You can refer it from there. So I am starting with the case study. Yes. So this is a case study which is of a company where the chief financial officer has resigned and the company is looking for a new CFO. And in the process, it has shortlisted some candidates and they are being given some issues which are related to all different aspects of the business. So direct tax, indirect tax, some aspects are relating to law, then the financial reporting, Ind AS. So they want to decide on the basis that if a candidate has a integrated knowledge or a thorough knowledge of all these aspects. Now, this shows that, as I already said, that in today's world or today's business world, chartered accountants are seen as a complete business solution provider. So it is expected that if we want to move up the hierarchy, if we want to have a higher responsibility job, then we should be conversant, we should be thorough in all the aspects, and we should know how we have to apply these aspects in a business situation, in a business scenario, in a collective manner. And that is how the candidates are being tested here. So let us go through the case study once. The Vanton Terun Limited is a fast growing listed company focusing on innovation in the textile and garments industry. The company has grown in last 1 decade from Punjab to homes of millions of customers across 50 countries. So you can see that this company has grown very fast, and in 1 decade from Punjab, it has grown to 50 countries. So not only in India, it has expanded the business across 50 countries in the world. And it is aiming the target of becoming the most trusted brand that takes conscious care of its customers, employees, and all stakeholders and treats them the best. Okay. So the company's aim is to become the most trusted brand. And how? By taking care of its employees, its customers, and all the other stakeholders, and treating them in the best possible manner, because they know that this is the key to success. You have to treat your customers and you have to know their requirements. You have to serve them in the best possible manner. At the same time, you have to take care of your employees also, because they are your resources. They are the assets for the company, human resource assets. And the shareholders, because they are the one who have invested money. So their money is with which business is being run. So all three have to be taken at the same platform. All three have to be taken care of and they have to be treated in the best possible manner. This will help them in becoming the most trusted brand. So this is about the company WTL. The company also has 5 subsidiaries operating outside India in the same business line of garments and trading of some special types of yarns. So this is what the company is dealing in. It has 5 subsidiaries operating outside India and same line of business is there for these subsidiaries also. They deal in some special types of yarns. Just a minute. So after gaining experience as, financial statements of the company for the financial year 2023-24, the financial statements of the company for the financial year 2023-24 have already been prepared and audit was completed as per all the regulatory requirements. So this is the information which is provided about WTL. Now comes the CFO of the company. After gaining experience as CFO of the company, WTL for last 15 years. So Tiru has resigned. Tiru was the CFO of the company, this WTL, for last 15 years. So he had gained such vast experience in this company and now he resigned. Why he resigned? Because he started his own venture in professional consultancy with some other players in the same business domain. So now he started his own venture, he started his own business, and that is why he resigned. The management, now what was the option left with the management? They have to look for a new person now. So management of the company gave an advertisement in all leading newspapers for hiring qualified professional for the vacant post of CFO. As I already briefed you that this case study is about the filling the vacant position of CFO, for filling the vacant position of CFO, how they are going to test the new candidates. Now 50 applications were received by the company and all the candidates were competent and had good exposure in financial reporting, corporate governance, MIS reporting, capital budgeting, direct and indirect tax matters. So you can yourself see that the candidates were competent in all the core areas which a chartered accountant should know. So these positions can be filled by a chartered accountant also because these are the areas, these are our core competence areas. These are the areas where we actually, on which we delve upon. So management of the company decided to have interview board for selecting the appropriate candidate for the post of CFO. So they thought that we should form an interview board which will select the appropriate candidate because all candidates appear to be very competent and they possess all the required knowledge, very good exposure of all the core technical areas of the business. Now, after looking at the recent developments in various areas relating to the operations of the company, accounting and other technical aspects of the Companies Act, GST, etc., the following issues as per the books of accounts of the company were selected, on which opinion of all the candidates was sought. So this is how they decided that they are going to select the new CFO. They will give them the certain issues which are related to this company, relating to law, then accounts, and indirect tax laws, GST, customs, and also the direct taxes. Then they will, and whosoever gives the correct response will be selected for next round of interview. So first shortlisting will be on the basis of the answers or the resolution, the solution provided by the candidates for these issues which the company poses before the candidates. You are also interested in this job. Now you have to assume that you as a chartered accountant are also interested in this job profile and have been asked the following issues during the interview. So we'll be going these issues one by one. And in fact, our questions will also arise from all these issues. We have been tested on the questions which arise from each of these issues. So as I already told you that we have with us the faculty for all other subjects also, and this is a multidisciplinary case study. So faculty for other subjects are also there. So these issues will now be taken one by one by the other subject faculties. And first of all, we will have the, we have issues relating to goods and services tax, customs, direct tax laws. Then we have issues regarding the customs, GST, direct tax laws, as well as the financial reporting paper and law paper. So let us start with the this first issue is actually relating to the GST and customs. We'll take it afterwards. I will not brief you each issue. Surprise you with the concept. So I hope the other subject faculty have joined us. Yes, they are joining us soon. So they will be taking the concept, they will be taking the issues which are related to direct taxes, like issue 2 is relating to the Form 3CD tax audit. So what all we have to show in a tax audit report, which figures we have to show in tax audit report. In fact, first of all, we'll see the issue, then we'll see what is the question which we have been asked in the case study. So I think subject faculty has now joined.
Thank you, Shefali ma'am. Hello students, good afternoon. This is CA Dimple Goyal and I am your Direct Tax and International Taxation faculty. And I am here to brief you regarding the issues in this case study which is related to direct tax laws and international taxation. Yeah, Shefali ma'am, you can just stop sharing your screen. I'll share from here.
Okay, Dimple, I have stopped sharing my screen. Now you can share it and you can apprise the students with the direct tax issues which are there in the case. Then after that, the students Shraddha ma'am will take you through the the issues which pertain to the law subject. So over to you, Dimple.
Thank you, ma'am. Okay, student. In the case study, first we have to see the MCQ which is related to your direct tax portion. So I am just straight going to the second MCQ which is related to your direct tax provisions. Okay, what the MCQ says. MCQ, what is the requirement of the MCQ? It requires, with respect to the facts given in issue 2 above, the interest to be reported by tax auditor under the Form 3CD of Income Tax Act would be. So firstly, we have to go to the issue 2. What is the issue 2? What is the income direct tax provisions which are applicable in this case? Then we will see about the Form 3CD, what is Form 3CD and their reporting clauses. So I'm just moving to the issue 2 for which this MCQ is requiring about. This issue 2 is on page number 2 of the case study. It says one of the overseas subsidiary SSS Inc. has provided financial assistance to WTL. So who is the assessee? Who is our assessee in this case study? This case study is about WTL. So our assessee is WTL. And in the first line, it is mentioned that it has a subsidiary, overseas subsidiary, SSS Inc. Firstly, by reading this line, it should be come into your mind then that it's a subsidiary and it's an overseas subsidiary. So if you see the transfer pricing provision, it should strike your mind that SSS Inc. is a subsidiary. So it's a associated enterprises. So, and it's an overseas, so it's a non-resident associated enterprise. It should click your mind instantly while reading the first line itself. The said financial assistance is outstanding in the books of accounts of the company as foreign currency loan on which it paid an interest of rupees 32 crores in the last financial year. So WTL has paid some interest in respect of the debt or its financial assistance which it has taken from SSS Inc. The amount of TDS as applicable has been deducted and deposited within the due date. It means that this interest portion is, there is no other non-compliances in respect of TDS provision to which it can be disallowed. This interest can be disallowed. So it means it's allowed as per your PGBP, your profits and gains of business and profession, because TDS has been properly deducted and deposited within the due date. profit before interest, taxes, depreciation, and amortization, that is your EBITDA of the borrower, and your borrower in this case is WTL, in the previous year were rupees 100 crores and the amount of depreciation was rupees 15 crore. So this is the issue which is related to direct tax. First of all, while reading these facts, it should come in your mind that what is the applicable provision in this case. There is one Indian company, WTL. There is one non-resident AE, that is SSS Inc. The SSS Inc. has provided certain financial assistance, some loan to the Indian company WTL, and WTL has paid interest of 32 crores in respect of that loan. EBITDA is also given here. So if you read all these facts, then the relevant section should come in your mind straight. And the relevant section in this case will be your section 94B of the Income Tax Act 1961. Now we will see what is section 94B says, what are the applicability of section 94B, how it is impacting in this question, and then we will go to the form 3CD requirements. So what is section 94B and whether it's applicable in this case or not applicable? So this is your section 94B. First, we have to see for 94B to become applicable on an assessee, what are the preconditions? First precondition is that it will be applicable to an Indian company or to a PE of a foreign company in India. It means if the assessee is an Indian company or a permanent establishment PE of a foreign company in India, then this section will be applicable. First thing. Second thing, this Indian company and PE of a foreign company, it should be a borrower and it is paying interest or similar nature, which is deductible in computing income chargeable under the head PGBP. In respect of which, in respect of debt should be issued by whom? Debt should be issued by a non-resident being an A. So if the debt, you have received the debt from an Indian company, from another Indian company, then this section 94B would not be applicable. So the debt should be issued by a non-resident plus associated enterprises. If the lender is not an associated enterprises, then this section will not come into the picture. So first condition, applicability on an Indian company or a PE of foreign company. Indian company and PE of a foreign company is a borrower and it's incurring the expenditure of interest or similar nature, for which, for a debt which it has taken from a non-resident being a A. What is there any threshold limit to applicable this section? Yeah, there is a threshold limit that your interest or of similar nature should exceed 1 crore. Only and only in that case, this section 94B would be applicable. What this section 94B says? This section 94B is introduced in the Income Tax Act in line with the BEPS Action Plan 4. BEPS Action Plan restrict interest which an Indian company or a PE of a foreign company is paying to its non-resident AE. There is a threshold limit that up to that amount only the deduction would be available to an Indian company or a PE of a foreign company. What is the threshold limit that we are dealing with in section 94B? So this condition, your eligible assessee in respect of which debt, what is the threshold limit, all this you have to see in this case study. So whether in this case study, the basic condition are satisfied, whether your company is an Indian company, yes, WTL, my assessee in the case study, WTL is an Indian company, okay. So it is paying interest in respect of debt which is issued by a non-resident AE, yeah. If we go read the case study again, SSS Inc. is an overseas subsidiary. It means it's a non-resident AE of WTL. Whether the amount of interest which it is exceeding 1 crore, yeah, in this case, if we see the case study, the amount of interest is rupees 32 crores. So it's exceeding 1 crore rupees. So it means this section 94B would be applicable. Okay. It says the interest which we are talking about, that Indian company or PE of a foreign company is incurring, that interest shall not be deductible in computing income under the head PGBP to the extent that it arises from the excess interest. Now we will see what is excess interest. That will be in subsection 2. So first of all, there is a restriction on the amount which is deductible in computation of income under the head PGBP. It means the government is allowing only up to that amount, certain limit, that interest deduction is allowable in case of an Indian company or PE of a foreign company when they are incurring interest expenditure for non-resident AE. Suppose in your case, the amount is not borrowed from a non-resident AE. Instead of that, their lender is not an associated enterprises. But your associated enterprises, either they are providing implicit or explicit guarantee to the lender or deposit a corresponding or matching amount of the fund with the lender, then it will be assumed, it will be deemed that the loan has been issued by the associated enterprises. So if I go relate this proviso in this case study, suppose the financial assistance in this case study is not given by SSS Inc. It is provided by some ABC Inc. But SSS Inc. is providing guarantee to ABC Inc. that the loan would be paid in future, or the SSS Inc. has deposited the same amount of loan as a deposit to ABC Inc. Then it will be deemed that the loan has been issued by your non-resident AE, in spite of the fact that your lender is not an AE. So this is a deeming provision. So this is about the applicability. Then there is certain condition also about the non-applicability to whom this section would not apply. So the section would not be applied to an Indian company or a PE of a foreign company which is engaged in the business of banking or insurance, or such class of NBFC as may be notified by the central government. So in this case, if our company WTL is engaged in the business of banking or insurance, then 94B would not be applicable to WTL because it is engaging in the business of banking and insurance. But in our case study, WTL, whether it's engaged in banking or insurance, no, it's not engaged in banking and insurance. It's a textile and garment industry. So this section is very much applicable to WTL. Second thing, if the interest you are paying for loan that is issued by a lender which is a PE in India of a non-resident, being a person engaged in the banking of business. Suppose you're non-resident, it's engaged in the business of banking and it has set up a PE in India and you are taking a loan from that PE, then also this section would not be applicable. That interest which you are paying, that section is applicable to you, but the interest which you are paying to that lender, that will not be restricted under this section 94B. Now, what is the restriction? Because we have seen that interest shall not be deductible to the extent it arises from excess interest. But what is excess interest? Excess interest means the amount of total interest paid or payable in excess of your 30% of EBITDA, or interest paid or payable to AE for that year, whichever is less. In the Act, it is written that the amount which of total interest paid or payable. But if you see the memorandum and if you see the explanatory memorandum, then it is mentioned that the intention of the government is to restrict the interest paid or payable to the non-resident AE, not to the interest paid or payable to every person. So in this case, read this total interest paid or payable as interest paid or payable to a non-resident AE. So in a nutshell, what it says, your first condition is that the interest which you are paying to non-resident AE in excess of 30% of EBITDA, or interest paid or payable to non-resident AE, whichever is less, that will not be allowed. It means, if I say in other words, it will be like only maximum interest which is allowed under section 94B is your 30% of EBITDA or interest paid or payable to AE, whichever is less. Suppose you have the EBITDA is, in this case, as your EBITDA is suppose 200 and you are paying interest of rupees 90 lakhs. So the interest which would be allowed is 30% of your maximum interest that will be allowed is 30% of EBITDA. 30% of your 200 lakhs, it means 60 lakh. 60 lakhs, and actually what you are paying 90 lakh. So that what would be allowed? 60 lakh would be allowed and the remaining 30 lakh would be disallowed. But if you are paying only 50 lakh, then definitely deduction would not be available for 60 lakh because that's the maximum deduction amount which you can claim. So in that case, deduction would be allowed to your interest which you are actually paying, which is 50 lakh. So for this, just keep in mind the section talks about the non-deductible amount. So in another way, what it says ki allowability will be maximum of 30% of your EBITDA subject to the actual interest paid or payable to associated enterprises. What about the portion which is disallowed under section 94B? Whether that will be lapse? No. Subsection 4 provides us for the carry forward provisions in respect of that interest expenditure which are not deductible under subsection 1. That shall be carry forward for how many years? For your 8 years following the current assessment year in which it is disallowed. And it shall be allowed in the next year, that 8 assessment year, maximum up to the limit which is prescribed under subsection 2. It means next year, if suppose you have disallowed, some interest is disallowed in this current year, that will be carried forward to next year. Next year also, you will be allowed only 30% of EBITDA. But in that case, if suppose there is a disallowance further also, that doesn't mean that the brought forward loss you are allowed, brought forward interest you are allowed. Brought forward interest you will be allowed up to the maximum interest which is allowable under subsection 2, which is 30% of your EBITDA. So this interest will be, can be carried forward for 8 years, for 8 assessment year. 8 assessment year from the succeeding assessment year in which the interest was first disallowed. So in this case, now we again go back to the case study and we'll see what is there any implication because of section 94B in the case of WTL? So what we require, the interest which the assessee is paying to non-resident AE and the EBITDA. EBITDA is what? Your earning before interest, tax, depreciation and amortization, which is already given as 100 crores. So is it relevant the amount of depreciation 15 crores? Students, just participate in this, whether what will be your EBITDA for the purpose of computation for section 94B. Your EBITDA will be considered as 100 crores or 115 crores. As your section 94B say restrict the interest up to 30% of EBITDA. So for that, the EBITDA which we need to be considered, that should be 100 crores in this case, or it will be 100 crores plus 15 crores, 115 crores. Yes, Jyoti Kumari, you are right. It will be 100 crores because it is already given EBITDA. You don't need to further add 15 crores, but because the profit which is given, that is before deducting your depreciation amount. So you don't need to add back again just because the information is given in the facts. So your EBITDA is 100 crores. So what would be allowed? Only up to the 30% of 100 crores, which is 30 crores. So what company has paid? Company has paid 32 crores. So it means disallowance will be of 2 crores. If we see this by the exact provisions language, what the provision says total interest paid or payable in excess of 30 crores. I have already told you total interest paid or payable, you have to interpret it as interest paid or payable to non-resident AE, which is 32 crores in this case. in excess of 30% of EBITDA, that is your 30 crores. So this first part would be how much? It would be your 2 crores. Interest paid or payable to non-resident AE minus 30% of EBITDA. That is 2 crores in this case, or interest paid or payable to non-resident AE, which is 32 crores, whichever is less, which is 2 crore, that would be your excess interest, and that would not be deductible. So 2 crore would not be deductible. Yes, Manisha, 100 crore will be the EBITDA. So 30% of EBITDA, that is the maximum interest which is allowed, and the remaining portion, the 2 crore amount will not be allowed as interest deduction under section 94B. Is it clear, student? Because once you understand section 94B, then we will see what is form 3CD and how to report this information in form 3CD. Is there any clause in form 3CD? Which clause is there? What to report, what not to report there? Yes, Shankara, you are right. 2 crore is the excess interest which is not allowed, which in the hands of WTL. Okay, Devraj, it's clear. Then we go back to the requirement of the MCQ. MCQ says the interest to be reported by tax auditor under form 3CD. Now we have to see what is form 3CD. For under section 44AB of the Income Tax Act, it prescribes that certain person whose turnover, gross receipt, sales, if it exceeds certain threshold limit, they are required to get their books of accounts audited. The person who is engaged in the business or profession and their turnover, gross receipts, sales, if it exceeds a certain threshold limit, they are required to get their books of accounts audited. Then if suppose that person who is engaged in business or profession, if they are required by or under other law to get their books of account audited, then it would be deemed as a compliance under section 44AB if they submit that report under the other law, and they have to submit report in the form which is prescribed by Rule 6G. So that will be sufficient if they are required to get their books of account audited under any other law. What are the forms they have to fill? That we will be seeing. There are 3 forms: Form 3CA, Form 3CB, Form 3CD. If the person who is engaged in business or profession and they are required by or under any other law to get their books of account audited, then they have to submit that report which is required under that other law, plus they have to furnish a statement in form 3CD. They have to furnish what? They have to furnish the report under any other law, plus they have to furnish the report under form 3CA and some particulars which are required under section 44AB in form 3CD. So they are required to fill 3CA and 3CD along with the audit report. If the person who is engaged in business or profession, but they are not required to get their books of account audited under any other law, then they have to submit the report under section form 3CB. Along with that, they have to submit some statement which is required under section 44AB in form 3CD. It means form 3CD is common if the section 44AB is applicable to them. It means if they are required to get their books of account audited under section 44AB, they have to fill form 3CD, which requires certain statements which they have to be filled by the accountant. What is the form 3CD clauses? Is there any clause in respect of this transaction, that transaction which relates to 94B and disallows some interest portion in the hands of Indian company or PE of a foreign company. So I'll just open the form 3CD. This is the form 3CD. Form 3CD is prescribed by the rule 6G. That is the statement which has to be furnished under section 44AB of the Income Tax Act 1961. There is a clause 30B. What it requires, whether the assessee has incurred expenditure during the previous year by way of interest or of similar nature exceeding 1 crore as referred to in subsection 1 of section 94B. So firstly, you have to see the applicability of 94B. Is there 94B applicable? If yes, then you have to report that in clause 30B of form 3CD. In our case, since WTL is paying interest of 32 crores to its non-resident AE, it has to report, the accountant has to report this thing under clause 3B. So what will be your answer in this case? Yes, the assessee is WTL. It has incurred interest or similar nature amount exceeding 1 crore, which is referring to 94B. 94B referring to means interest which you are paying in respect of loan which has been issued by a lender, which is your non-resident AE. Because you have to see as referred to in subsection 1 of 94B. 94B relates to the interest which is in relation to loan or debt issued by a non-resident AE. Then only the answer will be yes, which is in our case. If yes, yeah, please furnish the following details. What are the details the accountant has to furnish? Amount in rupees of expenditure by way of interest of similar nature incurred. That amount of interest by way of interest or similar nature incurred. Since here interest or similar nature incurred is written, that doesn't mean the total interest which the company is paying you have to report here. You have to read it along with the subclause A. It means the interest they are talking about in respect of the interest which they are paying to non-resident AE only, that you have to be report here. So interest or similar nature amount incurred, what is the amount that WTL has incurred in this case? Is your 32 crores. Second, earning before interest, tax, depreciation, amortization during the previous year. What is EBITDA in our case? In our case study? Tell me. Mansha, this form 3CD, you can get it from the income tax website, and the clauses which I am discussing, clause by clause discussion is already given in your core paper 4, direct tax laws and international taxation. If you see on the website, I'm just going to the website just because Manisha has asked to upload this form 3CD. If you go to the student BOS knowledge portal, your study material is there for May 24 and November 24 examination. If you go to the new study material, final paper, in module 3, there's a last chapter, tax audit and ethical compliances, which is all about your tax audit requirement and the ethics in which you have to follow by while filling this form 44 AD. What are the requirements and what clause by clause discussion is there on this form 3CD. If you see, it starts from page number 12, your clause by clause analysis of form 3CD. So it's already discussed in your study material in chapter 20, and you can get this form 3CD from the income tax website also. So first requirement was expenditure which is WTL has incurred by way of interest and similar nature, that is your 32 crore. The second reporting requirement is your EBITDA, which is 100 crores. And the third, amount of expenditure by way of interest or of similar nature as per above one, it is 32 crore, which exceeds 30% of EBITDA as per 2. It means your 32 crore minus your 30 crores. So it means we have to report the excess interest here, which is disallowed under section 94B. So which is 2 crores. Then there are further details regarding your brought forward and carry forward interest, which we have to report. If you have brought forward interest from the earlier year, that you have to report, and the interest which you are carrying forward to the next year, you have to show in this portion. So now again back to the case study. What are the options? A, you have to report, tax auditor has to report 30 crore and 2 crore under clause 30B. In this case, tax auditor has to report the amount of expenditure which the company has incurred. Company has incurred how much expenditure? Company has incurred 32 crore expenditure, but allowed is 30 crore, but company has incurred how much? 32 crore. So tax auditor, the first answer would not be correct because 30 crores you are not reporting. You are reporting the amount incurred. C is 32 crores and 34.50 crores. I don't know how this 34.50 crore has arrived because in my case it's 32 crore. There are three amount: 32 crore, 30 crore and 2 crores. So C option is incorrect. D is 32 crores under clause 30A. First of all, the clause which is relevant for 94B is 30B, not 30A. So this option is also incorrect as in option C. Now, what is option 2? Rupees 32 crores and 2 crores under clause B. Yes, in form 3CD under clause 30B, you have to report in first 32 crores as the interest incurred by the WTL, and in third your rupees 2 crore as the excess interest which is disallowed by virtue of section 94B. So the correct answer would be in this case your option B. I hope student section 94B is very much clear to you, and the reporting requirement is also clear to you in form 3CD regarding in relation to 94B. Thank you so much, Shankara. It is obliged that you understand the provision very well. Devraj, Mansha, if you have any doubt, just let me know. Yes, Mansha, the correct option would be option B. Your 32 crores and 2 crores under clause B. So the MCQ which is related to your direct tax or international taxation portion, I have taken up. Now I just handed over to Ms. Shraddha to take the MCQs or descriptive part which is relation to law.
So now Shraddha will join to explain the issues which are there relating to law paper, because as we have seen, Dimple has very beautifully explained the provisions of section 94B along with their disclosure in form 3CD. So regarding that issue was issue 2. And now the issue relating to law paper will be taken by Shraddha. So she will be joining us soon. In the meantime, let me take you through in the meantime, Shraddha is joining. I think she has joined, I suppose. I'm taking you through the issue which is there, which she would be taking. That is issue 3. the company has to, in fact, I would share the screen. Okay, she has joined. So she will share the screen with you and she will explain the provisions. So I think, Shraddha, now you will take issue 3 and
Yes.
issue 4 with the students, na?
Yes. Good evening, students. So Shefali ma'am has already apprised you with the related things in the case study, and Dimple has beautifully explained the related provisions in respect to the Income Tax Act. Now we will be discussing the issues related with the Companies Act. I am CA Shraddha, and I will be taking you through the company law portion in this. So just hold on for a minute. I'm just sharing my screen. So students, I think you can see my screen. So the issues related with the company law portion are basically issue 3 and issue 4. If we go to the MCQs portion, we can see that there is one MCQ, MCQ number 3, and we have another MCQ, MCQ 4. Let's start. If we read this MCQ, which is your MCQ number 3, in the background of circumstances described in issue 3, the company secretary contends that the audit committee should be reconstituted even if Q is appointed as independent director. So in order to understand the issue, we have to read issue 3 of our study material, case study. Issue 3 says, company has to comply with listing obligations and disclosure requirements relating to corporate governance, and for this, independent and a qualified audit committee is already formed and functioning. The audit committee consisted of 6 directors having wide experience in corporate matters, with 4 of them being independent directors. One of the directors, P, whom they are saying is an independent director, has resigned as a director of the company. WTL proposes to appoint Q as an independent director who is already serving as a managing director in one of the company and independent director in 3 other listed companies. So if I see this, it seems to be a very simple thing. But if I read it again, can you please make out, is this issue related with the Companies Act 2013, or is it related to some other act? So by the time I'm waiting for a response from the students that what can they make out from this issue, I just want to know the act with which this particular issue is dealing. In the meantime, I will give you a brief idea. If we see, there are 2 main things that this paragraph is talking about. One is about the audit committee, and the other thing is relating to the number of independent directors in the audit committee. So why do we need independent directors, or what is the need of an audit committee in our company? If we go at the starting of this case study, we can seriously see it says it is a listed company. So the moment we read the line listed company, our mind should start working that what kind of provisions would be applicable on such a company. So I have received answer from 2 students, but I'm still waiting. And the students who have given the answer, by Siani Ganesh, you are correct. So let's wait. And one more student has given the answer. That's also correct, but let us wait if some other students can also give the answer. So what is the need of an independent director in a company? It is imperative to know that the board of directors of a company consists of two types of directors, basically. They can be categorized in two types. One is your executive director and the other is your non-executive directors. What are your executive directors? These are the type of directors that are primarily responsible for managing different business operations that are undertaken by a company. The company cannot take decisions on its own. So they have a group of people who are known as directors who will be taking the decisions for the company, because the shareholders themselves cannot come and take all the decisions. So they appoint a particular number of people known as directors who will be taking the decisions on behalf of all the shareholders of the company. Okay, so these executive directors are primarily responsible for taking the operational decisions of the company. Then why there is a need for independent directors, or rather I should not use the word independent directors here, rather we should say non-executive directors. The non-executive directors of the company are more entrusted with the policy making decisions of the company and efficient management of the company. And it is very important to know that the independent directors are a kind of non-executive directors. Okay. So yes, very good. Students, you have understood this, that it's related with the SEBI LODR. Very good, because generally students are not able to make out that whether in this case we will be applying the provisions of the Companies Act 2013 or the SEBI LODR regulations. Okay, so we were talking about independent directors. So these independent directors are such directors who are people of integrity and they possess relevant expertise and experience in the particular field. So what happens? These independent directors have an independent mindset and they are not influenced by the other members of the board. That's why they are called the independent directors. And what is the real need? Supposedly, the other members of the board are taking some decisions which are not in consonance with the policy of the company or which are not in the best interest of the companies. Then these independent directors can come forward and they can hinder the decision of the other members of the board. That's why, as per section 149 subsection 6 of the Companies Act, it has been mandated to appoint a certain number of directors as independent directors. Okay, so there is a particular need for this independent directors. Moving further, we are in this issue also dealing with the audit committee. It is a listed company, we have seen it. So there are obviously many checks and balances to ensure that the funds of the shareholders are in the safe hands. So in case of listed companies, we have a mandate with respect to this independent directors. We also have a mandate with respect to audit committee compliances. Why an audit committee? Remember students, audit committee is one of the main pillars of corporate governance. The audit committee aims to enhance the confidence in the company's financial reports and announcements and the internal financial controls and everything. If an audit committee is saying something, then it means that the company is bound in many cases to apply it. It ensures the confidence of the shareholders as well as the public at large. And that's why all the listed companies have a certain regulations, a greater level of regulations with respect to listed companies, so that the shareholders' money is kept safe and is best utilized. So since we have received the answer with respect to that, it is in relation to the SEBI Act, and in particular with the SEBI LODR regulations. Why? See, the first line in this, first of all, it is a listed company that we have seen. Secondly, if we see, the first line of the issue 3 says, company has to comply with listing obligations and disclosure requirements. So they have given you a hint here also that these are the SEBI LODR regulation. A student can be confused if they directly read the question, then they may think that this issue is with respect to Companies Act or SEBI LODR. So they have given one more clue. Now we have to understand, can any of the students, while I'm explaining, tell me that do we have to apply only one kind of listing regulation here, or we have to apply more than one listing regulation? So the question is, the issue is that the audit committee has 6 directors, and they have given that having wide experience in corporate matters, with 4 of them being independent directors. So this is the current scenario. This audit committee is having 6 directors, and out of them 4 are independent directors. One of the directors, P, an independent director, has resigned as a director of the company. How does it really matter? Will it make a difference to me? Okay, correct, Tanisha. It has more than one listing regulation. So does it really matter to me if someone has resigned? Like majority of them, like I have 6 members in the audit committee, and if one has resigned, one independent director has resigned, I still have 3. So it's a 50-50 ratio. It should not matter. No. If I go to the SEBI listing obligations and disclosure requirements regulations 2015, and in that I refer to regulation 18. It says every listed, मुझे तो याद ही नहीं है, I don't remember what the regulation is, but I hope you all are knowing one thing, that this is an open book examination. If my mind clicks that, okay, I have to see SEBI LODR regulations, automatically, since I will be carrying a book or something and through which I can refer that regulation, I need not memorize everything. I need to keep a note of everything in my mind, but there is not a need to memorize everything. So the student who is knowing that, yes, I have to see the LODR regulations, I will go to the SEBI chapter and and I will open my LODR regulations. I hope so you are able to see. See, I have a computer, so I have done just a Control F, but you also have this key. If you know what regulation you will be referring to, then in that case, directly you will be going to that regulation and you will be referring. So you need not memorize everything. Set A that you are referring to right now, the paper of Set A, this is corporate and economic laws. So what is that? You will be doing it before your final examination, but since you have read everything, you know everything, your mind is a sharp tool, so everything will be here. So directly you can go to the regulation, open it, and then you can read. I'm just increasing the font. Okay. Every listed entity shall constitute a qualified and independent audit committee in accordance with the terms of reference, which shall have what? The audit committee shall have minimum 3 directors as members. In my question, even if one director leaves, I still have 3 directors. Now, so it's done. At least 2/3 of the members of the audit committee shall be independent directors. Okay. So now this is the clause that I need to see. What is the clause in my question? Let me just increase the font. So the audit committee is consisting of how many directors? It's consisting of 6 directors. Okay. And 4 of them being independent. So my audit committee is having is required to have minimum 3 directors and I'm having 6. So this is compliant. Next is the audit committee needs to require at least 2/3 of the members as independent directors. So 6 into 2/3 is 4. That is also complied with in the current scenario. Now the next line. One of the directors P, an independent director, has resigned as the director of the company. So if he's resigning as the director of the company, what will happen? Then automatically he will be removed from the audit committee also. So now the audit committee will not be having the requisite number of independent directors. So if I do 5 into 2/3 and then I have to round it off, I am not having the requisite number. Okay. In that case, there is a need to appoint someone else as an independent director. First of all, there is a need to appoint another person because I am in need of one more independent director. Supposedly, the company says that I am appointing anyone. That would not suffice my purpose. My purpose would be sufficed only when I appoint an independent director. So let's read the next line. So let's read the next line. One of this WTL proposes to appoint Q as an independent director who is already serving as, let's stop till here. WTL proposes to appoint Q as an independent director. Mera kaam done hai. My work is done. I have appointed one more independent directors. So the number of members would again be 6 and 4 of them being independent directors. My work is done. No. The answer is still no. Why? Who is already serving as a managing director in one company, an independent director in 3 other listed companies? So that brings another point to my notice that I have to, if I see regulation 18, it does not talk about this. It nowhere talks about that the managing director part or anything. So that means I need to refer some other regulation also, which I was saying. So in that case, what I will be doing, I have to refer. You don't need to memorize the regulation numbers. Okay? You don't have to memorize the regulation numbers. It's just for the purpose of reference. 17A. Maximum number of directorships. The directors of listed entities shall comply with the following conditions with respect to the maximum number of directorships, including any alternate directorships that can be held by them at any point of time. So a person 7 listed, will this suffice my purpose? No, because I am falling with the clause 2, notwithstanding anything above. The first one is saying that a person shall not be an independent director in more than 7 listed entities. If I don't see the word clearly managing director in issue 3, I can get confused. Okay, I'm fulfilling the condition, but no. I have to read the regulation in full. Notwithstanding the above, any person who is serving as a whole-time director or a managing director in any listed entity shall serve as an independent director in not more than 3 listed entities. So this is now one more thing. Okay. So going back to our question. So this WTL, the person Q that they have appointed, though he is an independent director, but it is not fulfilling a purpose for 2 major reasons. It is a man, he or she is a managing director and in one company, and he's already an independent director in 3 other listed companies. So obviously now he cannot be appointed as a independent director in this WTL. So if he cannot be appointed, so that means my purpose will not suffice. Okay. I hope so you are clear with the issue that is there. Now, moving on to the question that we have. Is there anything, students, that you are not able to understand with respect to the issues in this question, in this issue 3? Kindly let us know. Now, if we read MCQ number 3, in the background of circumstances described in issue 3, the company secretary contends that the audit committee should be reconstituted. Does the audit committee needs to be reconstituted? Yes or no? First of all, we should think about it. Supposedly, the people, they would be still having the requisite number of independent directors. Would there have been a need to get this audit committee reconstituted? The answer is no. But since the number of independent directors have fallen below 2/3, that's why there is a need to reconstitute this audit committee. Continuing with the question, even if Q is appointed as independent director. So first of all, this Q cannot be appointed as an independent director. Is the company's contention appropriate? So yes, the answer is yes. We now know that the audit committee should be reconstituted. But if we see the question, the options, option A is saying contention of company secretary is correct and the audit committee should be reconstituted. Okay. Option B is saying the contention of company secretary is not correct. Option C is also saying that the company secretary is correct. So now I can obviously get confused that I know the this audit committee has to be reconstituted. So I will be confused that which of the option is correct. Let's start from option D. Contention of company secretary is not correct as the audit committee is not required to be reconstituted due to change in its members. If I have understood the issues correctly, I am damn sure that this is not a correct option because we know that the audit committee is to be reconstituted. Then I will go to option number B because I know that's not a correct option. So that's why we are discussing in some random manner. Contention of company secretary is not correct. And the existing audit committee can continue as independent directors, constitute more than 2/3 of the total number of directors of audit committee. So this option is also not correct. Students, just imagine a student who has not read the issues correctly, even if they are knowing the provisions correctly. They can even mark the correct answer as B or D because for them, the contention of company secretary is not correct. So while doing the MCQs, not only of this subject, that is corporate and economic laws, of any subject, the options are so close to each other and they're so confusing. And even many a times the issues, the facts of the case scenarios are such that if you do not read them in entirety, you can get confused. So option B is also not correct and you should read very carefully. Now let's go to Option A, contention of company secretary is correct and the audit committee should be reconstituted. We are very definite, as it should have at least 2/3 majority of members as independent directors. This is a correct option because we know that 2/3 of the majority of members should be independent directors. But let's see what is there in point number C also. Is correct, as it should have only independent directors as members. Supposedly, the student does not understand the provisions fully, then they can think that only the independent directors are required to be the members of the audit committee. Then they can even mark option C. So if you see, you need to be very clear with the facts as well as the provisions of the act, and then you should be able to have a correlation between the facts and the provisions, and then with the amalgamation, you will be in a position to arrive at the correct answer, which in this case is option A. Very good, Mansha. So let's move. I hope it is clear to you all. So let's move on to our next MCQ, which is your fourth MCQ. So WTL shall appoint another women director on the board of the company on or before. Very easy question. I don't need to even think about that, what we have to write. So I can write the answer without even seeing the facts of the question. Never ever think so. Sometimes students say, I have done everything correctly. What happens is, if you do not read the facts correctly, one thing is that you need to be clear and crisp, and you need to remember a bit of the provisions in your mind. Then you can search for those provisions. You need to be clear. But what are the facts of the question? You need to read those very clear. So now let's come to this issue. Arunima is a woman director of the company. Due to, thank you. Arunima is a woman director of the company. Due to her other engagements, she tendered her resignation from directorship with effect from 1st March 2024. Wired her letter dated 15th February 2024, which was received by the company on 20th February 2024. The board took a note of resignation in its meeting held on 15th March. Usne resign kya? Kab kiya? So she has given a letter on 15th and the company has received the letter on 20th. So let's count the date. Okay, I need some dates and it will be done. No. No. Never ever attempt any question like this. Until and unless you are very sure of what the provision says. Is it even necessary to appoint a woman director in the company? Okay, we need to look for this. Was there a need in this company that a woman director should be there? Okay. So for that, I need to see since it's a listed company, do I need to see the Companies Act, or do I need to see the SEBI regulations? I'm waiting for an answer. Okay, meantime, the students are giving me an answer that whether we have to attempt this particular issue with the help of SEBI requirements or the Companies Act 2013. Why there is a need of a woman director? Or why is there a particular provision with relation to women director in the company? Okay, so we know that the board of directors are the highest level of decision making in the company, and they have governance responsibilities with them. So directors play a very pivotal role in the decision making and management of the company. And in order to, yes, very good, Tanisha, it has to be attempted with the Companies Act 2013, Section 149. Very true. So there is a specific need to have the board of directors. And in order to reduce gender biasness, and in order we have a particular Article 14 of the Constitution, which says about right to equality, which also talks about right to reduce gender biasness. So the Companies Act 2013 has taken all the requisite steps to ensure that there is a or more than one women director on the board of a company. So this participation of the women director will also help the company to reduce gender biasness and promote Article 14 of the Constitution. And students, if you see, whenever we are reading law, though we have to read what is given in the act as it is, but many times the things are coming from the journal scenarios or the Constitution. So the Companies Act 2013 has introduced the concept of women director in the Companies Act 2013. And they are trying to increase the role of women directors. And you will be happy to know that after 10 years of the implementation of the Companies Act, I'm not saying that before that there was no participation of women directors in the board of directors. There are many companies who have the highest number of women representation in their board. And we should applaud companies like Apollo Hospitals and Zomato or Humans India or Nestle India. They have the highest women representation on their board. So coming back to the topic, we are talking about women directors. So section 149 talks about that at least one women director shall be on the board of such class or classes of companies as has been prescribed in Rule 3 of the Companies Appointment and Qualification of Directors Rule 2014. So now I will be again going back and telling you how you will be referring the provisions from your study material, because you will be carrying the study material in the examination. My system is not behaving properly. I'm sorry. So I have to scroll through the pages. So at least one women director shall be on the board of these companies. And what are these companies? Rule 3 provides that the following class of companies shall appoint at least one women director. So the first one is every listed company. So now we are damn sure that issue number 4 is very valid, that yes, we have to appoint a women director. Okay, woman director. So because our company is a listed company. Supposedly, had it been any other public company, then in that case, we have to see the paid up capital, which is 100 crore or more, or turnover of 300 crore or more. Then in that case, those companies have an obligation to appoint a woman director. So in our case, it's a listed company. We will be appointing a women director, which they have rightfully done. So now the issue is, in our question, if we see, this woman director, that is Arunima, has resigned from her directorship. Why we were reading till now that is there a need to have a woman director? The specific reason was that if it is not mandatory for my company to appoint a woman director, but I have appointed a woman director, and if she has left the company, what so? In this case, there is a mandatory requirement as per the Companies Act of this company, WTL, to appoint a woman director. So when she leaves the company, it again becomes important for the company to appoint some other woman director in order to comply with the legal provisions of the Companies Act 2013. So that's why we were talking till now that why we need the women director and which companies we need a woman director. Okay. So this woman director, Arunima, has left and she has resigned from the directorship. Kindly, dear students, somewhere note these dates that she has resigned from the date with effect from 1st March 2022. Then, void her letter dated 15th February 2024. So one is the effective date, which is your 1st March 2024. On what day she tendered this resignation? The date of tendering this resignation is by the letter dated 15th February 2024. And this letter was received by the company on which date? So this was on 20th February. The company received the letter of resignation on 20th February 2024. Now, board took a note of the resignation in its meeting held on 15th March 2024. So we have these 4 dates. If I'm clear about the provisions of that, then I will be able to know that what date I have to take into consideration. There is a term known as intermittent vacancy that has been used in your study material. Why I'm using this term, intermittent vacancy? When the women director will be leaving the office, then an intermittent vacancy will arise in her office of directorship. So I need to know the term intermittent vacancy. So once I know this date, I know that we have to appoint. I will be going to the point filling of intermittent vacancy. So any intermittent vacancy of a woman director shall be filled up by the board at the earliest. At the earliest means jaldi se jaldi, as early as possible, but not later than. एक तरफ तो they are saying at one place they are saying that at the earliest, as soon as possible, but then the act is saying but not later than. They're trying to confuse the students. No, they're trying to give the board an opportunity to appoint a correct person as a women director. They should not just appoint any women as a women director in order to be compliant of the legal provisions. Then they are saying, they are requesting the company that please, if there is an intermittent vacancy, appoint a woman director, okay, as soon as possible. But then they are saying, though we are giving you the time, but remember, it should not be very late. What is those dates? But not later than the immediate next board meeting. So what is the date of my immediate next board meeting? My immediate next board meeting is on 15th March 2024, going again with the provisions, or 3 months from the date of such vacancy. Students, write it fast. What is the date of vacancy here? Is it 1st March, 15th February, or 20th February? So, okay, very good, very good. Very good, students. So that means you have understood the provision very correctly. So the effective date of resignation, 3 months from the date of such vacancy. So the date of vacancy, because they have written with effect from 1st March 2024. Supposedly, a person has resigned and they have given the resignation with effect from today. So it will be effective from today. In this case, though she has given the resignation on 15th February and it has reached the office on 20th February, but is she not working for the time period of 15th February or 20th February to 29th February? She is very much the part of the board of directors because her resignation is effective from 1st March 2024. Okay. So here, the effective date would be 3 months from the date of such vacancy, 3 months from 1st March. And then come another clause, which is whichever is later. So what do we mean by whichever is later? Just make a chart saying immediate next board meeting. Immediate next board meeting is on 15th March 2024 or 3 months from the date of such vacancy. So vacancy was on 1st March. If I calculate 3 months from there, what I will get? I will get 1st June. Now I have to compare two dates. One is your 15th March or 1st June, whichever is later. So what is obviously later? The later date is 1st June 2024. So now we have the answer here. Obviously, WTL shall appoint another woman director on the board of company on or before, because we are saying not later than. The provision says not later than, and then we are saying whichever is later. So the which later date is our 1st June, but we cannot go beyond 1st June. So on or before 1st June. Okay. In this case, the answer is clear cut, that it's 1st June 2024. Okay. Now, suppose in this question, there is one more thing. Here in the question, they have given us the date as 15th March 2024 and the company, supposedly the board, let's see, the effective date is 1st March. So 3 months from 1st March is 1st June, we know. Now, the board meeting, hypothetically, I am saying, did not happen till 15th of June. So now I have to compare two dates. This is an extension that I'm telling you. Suppose if the question is, say, 3 months from 1st March is obviously 1st June 2024. But hypothetically, I'm taking an example that the board took note of the resignation of this meeting, the immediate next board meeting. The provision says, na, immediate next board meeting. Suppose this immediate next board meeting happened on 15th June 2020. In that case, also, what is the correct answer? Now I have to compare two dates. Immediate next board meeting, which is your 15th June 2024, or 3 months we have calculated 1st June 2024. The point is whichever is later, whichever is later. So in this case, the later date is 15th June 2020. So my answer will automatically change. So this provision seems very simple, but we have to keep in mind not later than the immediate next board meeting. This is one leg. The other leg is 3 months from the date of such vacancy. And then when we combine, whichever is later. I hope so, students. Thank you, Mansha, Tanisha, for getting us with the correct answers. And earlier this Shankara O. Mansha, you have been a very good participation. I hope so. Both these provisions are clear to you and you have understood. Dear students, with this, I end what I have to tell you about the MCQs, but there is one caution I would let you know. While doing the questions during the examination, here we are explaining to you the, what do we say, the provisions in detail, and we are taking things further than what are given in the issues or the MCQs. It is just to explain that how can you interpret the issues and how can the MCQs can be tinkered, and just with a little bit of tinkering with the facts of the case, the answer will change automatically. So that's why we are explaining you so much. Hope so you have understood both these MCQs, and with this I will be signing off and handing over the session to Shefali ma'am, who will be taking you through with the further MCQs. So thank you, students, and have a nice day. Good evening.
Thank you, Shraddha. Thank you so much for elaborating the concept relating to listing requirements and women director provisions. And in fact, I can see that from the response of the students that they have understood the concept well and they are enjoying the session. In fact, I appreciate that all the students are participating and they are replying to the queries or the questions being asked by the faculty. So that means the session is being interactive and everybody is participating and understanding the concepts. So this is what the objective of this session initially was. Now I will once again share the screen so that we can discuss the indirect tax related issues and questions. Now, regarding indirect tax, the provision which is related or the issue which we have to deal for the purpose of which relates to indirect tax is issue 1. The company is operating in 50 countries. So employees of the company travel worldwide to oversee the operations and for business expansion. So we had already seen that the company it started from Punjab, and then over a decade, it expanded to more than 50 countries. So since it is operating in so many countries, its employees have to travel worldwide for business, for overseeing the operations, for expanding the business also. And for this purpose, they need foreign currency. So foreign currency is taken from authorized dealers who charge GST as per relevant provisions of GST law and applicable valuation guidelines, and used for meeting all overseas expenses, including stay, local traveling, and food expenses in foreign countries. For the upcoming business trip, the employees will be traveling to United States of America and require US dollars 10,000. Company purchased the foreign currency. Now they required $10,000. Company actually purchased 9,900 US dollars by paying 7.4 lakhs. However, the customs exchange rate and the bank buying rate on the same will lead to an amount of 7.4 lakhs and 7.5 lakhs respectively for equivalent number of dollars on the same. Now, before moving to further information in issue 1, this is actually one of the issues that the company is purchasing foreign currency for the foreign travel of its employees. Now, though the question itself specifies that the GST is being charged by the dealers who are selling the foreign currency, because foreign currency you have to purchase from the authorized dealers, or in case you want to sell your foreign currency, that could also be a case. In this case, we are purchasing foreign currency because we want our employees to travel abroad. Now, this purchase and sale of foreign currency is liable to GST. So let us see the related MCQ or the question which is there in our case study so that we can appreciate better the provisions as well as the requirement of the question. On the basis of that, we'll go through the provision. What is the question which is related to it? It is the first MCQ only. It says in respect of purchase of foreign currency from authorized dealer, whether GST will be applicable, and if yes, what will be the value of services on which GST will be charged under Rule 32, Sub-Rule 2, Clause A of the Central Goods and Services Tax Rules 2017. Also calculate the GST amount assuming the tax rate at the rate of 18%, because you know that under GST law or at the final level also, students are not expected to memorize the rates of taxes which are applicable on a particular supply of goods or services. That is why you can see that rate of GST applicable on this service is given here. Now, so this is very clear that the information which was given to us regarding purchase of foreign currency for the foreign travel of the employees, with regard to this information, we have to compute the value of supply of said service of purchase of foreign currency as well as the GST which is payable on the same. Now, before this, in order to have the complete conceptual understanding regarding the transactions in money or regarding the foreign currency purchase, I will take you through the taxability of transactions in money or money per se under the GST law, so that you can understand the concept, and then we'll see the valuation. Because we should know the concept first and then we should solve the questions. Now, under GST law, the GST is always leviable on supply. Supply is supply of goods or supply of services. So we have specified definitions of goods as well as services. Now, in case of goods, the term money has been specifically excluded. That means money is not considered as goods under GST law. Similarly, from services also, money has been excluded. Now, what does it mean? It means that since we said that supply should be supply of goods or supply of services for the purpose of leviability of GST. Since money is excluded from goods, excluded from services, that means if there is any transaction in money, GST cannot be levied on it because it will not be considered as supply. However, the definition of service, it explicitly provides or it explicitly includes the use of money or conversion of money from one currency to another under the purview of services. So when conversion of money from one currency to another has been specifically included in the definition of services, therefore, the supply of this is a supply that it qualifies as supply because when we are converting the currency from one form to another form, it is considered as service. Supply is supply of goods or services. So this transaction of purchase of foreign currency or sale of foreign currency becomes a supply, and GST would be leviable on it in case consideration is charged, it is in course or furtherance of business. And these elements are present in our case. That in this case, the purchase of foreign currency is in course of furtherance of business and consideration is being charged here. So this becomes a supply, GST is leviable on the same. Now comes the question of valuation, because first of all, we have to see whether it is a supply or not. In this question, for the ease of the students, we have already provided the information that GST has been charged on the same. But had this information not been there in the question, then you had to see that whether purchaser, you should know that whether the purchase or sale of foreign currency, whether it is a supply or not. So it is a supply, it is leviable to GST in the given case. And now we have to determine what will be the value of supply. Now, generally, what is the value of supply? As per section 15 of the CGST Act, the value of supply is as per section 15 is transaction value. That means the value at which the transaction has taken place. Now, in this case of purchase of foreign currency, the value of service actually cannot be determined from the consideration which we have got by converting the foreign currency. That means the element of the service element in this particular transaction, we cannot expressly say that because the bank is charging only the buying rate from us, or we are buying the foreign currency from the bank. So whatever rate the bank is charging, we are paying only that much amount to the this authorized dealer or bank. Now, what will be the consideration or what will be the value of supply which we will consider for the service of purchase of foreign currency which we are receiving from the bank? This purchase of foreign currency, at what value we have to pay GST? For that, we have to go to the valuation rules because it is not expressly provided. We cannot take transaction value in this case, which is very high, 7.5 lakhs, so 7.4 lakhs, sorry. So we cannot tax 7.4 lakhs, entire 7.4 lakhs for the purpose of GST. We have to actually find what is the value of the service which the authorized dealer is providing to WTL. So for that, we have to go to the valuation rules. Okay. Sorry, I think I have stopped sharing the screen. Let me share it again. This is the relevant provision, that is Rule 32. Now, in fact, question itself provides you that you have to determine the value of this service as per Rule 32, Sub Rule 2, Clause A. In fact, value of supply of services of purchase and sale of foreign currency can be determined by virtue of Clause A or by Clause B also. But in this case, since it has been expressly provided to us that we have to determine the value as per Clause A, then we have to go to Clause A only. Otherwise, the supplier is at the discretion of the supplier that whatever out of these two provisions, whichever provision is more beneficial to him, he can go for that. Okay. Now, so in this case, we will go, and after determining this value, because there is a special provision for determining the value of supply of services of purchase or sale of foreign currency, we will be after determining, so in this case, we will be determining the value from this provision or Rule 32 2A, and after that, we'll determine the GST payable. So let us see the provision of Rule 32, Sub Rule 2, Clause A. First of all, we'll start with Sub Rule 2 only. The value of supply of services in relation to the purchase or sale of foreign currency, including money changing, shall be determined by the supplier in the following manner. For a currency, when now in case when the this foreign currency is exchanged from or to Indian rupees, that means one currency is foreign currency, other currency is Indian currency, then how will you determine the value of supply? The value of supply shall be difference in the buying rate and selling rate and the RBI reference rate. Now, in this case, we have to take the buying rate for the foreign currency, the rate at which the foreign currency is being purchased, and the RBI reference rate for that currency for dollar. In our case, the currency is dollar. So RBI reference rate for dollar at that time multiplied by the total units of currency. Now, in our case, the total units of currency will be 9,900 units. We have to, once again, we'll go to the case study and we'll see that how we will, what are the facts of the case and how will we apply this provision to our question. But the provision says that the currency for which the currency which we are purchasing and we are converting it into Indian rupees, or we are actually giving Indian rupees and getting dollars, or selling dollars to get the Indian rupees, either of the cases, then we have to take the difference between the buying rate or selling rate and RBI reference rate. So at the rate which we are actually paying and the rate which has been specified by RBI reference rate for that currency at that particular time when our transaction is taking place, we have to take the difference of the two. One is our actual rate and one is RBI reference rate. The difference between the two will be taken and we have to multiply it by the total units of the currency. That will give us the value of supply of services in relation to purchase or sale of foreign currency. In this case, we are purchasing the foreign currency. W2L is purchasing the foreign currency. Now, however, there could be a case where this RBI reference rate is not available. One of the currency which is being exchanged is Indian rupees, but the RBI reference rate for that currency is not available due to certain reasons. Then the value shall be 1% of the gross amount of Indian rupees provided or received by the person changing the money. That means whatever consideration that person is actually paying for getting the foreign currency, or whatever amount that person is getting by selling the foreign currency, either of the case could be there. The actual transaction which has taken place, whatever gross amount that transaction has been entered into at, we will take 1% of that amount. Okay. Then we have another case where neither of the currencies exchanges in rupees. That means, for example, we have given the US dollars in exchange of UK pounds. Now we had UK dollars with us, US dollars with us, and now we want pounds. So we have exchanged dollars for pounds, and money rupee did not come into purview in between. From dollars, we get the currency converted into pounds, and therefore none of the currencies was Indian rupees. Then how will we determine the value? The value will be 1% of the lesser of the two amounts the person changing the money would have received by converting any of the two currencies into Indian rupee on that day at the reference rate provided by RBI. Now, in this case also, RBI reference rate would come into play. We will take each of the two currencies separately and we will determine the amount that person would have got, though he has not converted any of the currency into Indian rupees. But whatever amount that person would have got had he changed his foreign currency into Indian rupees by applying the RBI reference rate. So we would take the units for which he is getting each currency exchanged, units of currency which he is getting exchanged, US dollars as well as UK pounds, units of each of these two currencies, and we'll multiply it with the RBI reference rate. Whatever amount will come, we'll compute 1% of these two amounts, and lesser of the two amounts will be in fact, we'll take lesser of the two amounts and then we can compute the 1% value, 1% of the lesser amount. That will be our value of supply of services. So first case is when when foreign currency is being exchanged for Indian rupees, then the difference between RBI reference rate and actual buying and selling rate, difference between the two will be multiplied by total units of the currency and we'll get the value. But in case RBI reference rate is not available, then next step would be 1% of the gross amount of Indian rupees which have been exchanged. If none of the currencies is Indian rupees, we are getting one foreign currency exchanged for another foreign currency, then in that case, both the foreign currency units will be multiplied with the RBI reference rate for rupee. That means they will be converted into rupee value. We'll take the lesser of the two amounts and then afterwards we'll take 1% of that amount to be the value of supply. Now, the person has option of clause B also. So he has to exercise the option at the beginning of the year that which of the two options, once he opts for an option for a financial year, then he cannot withdraw that option during the remaining part of the year. Now let us go to the case study and see that which of these provisions is actually applicable in our case study. In our case study, the information which is given to you is company purchase foreign currency 9,900 US dollars. The unit is 9,900 US dollars by paying 7. So this is US dollars amount. Now by paying 7.4 lakhs of Indian rupees. So this is actually the gross amount which has been received, which has been paid by the WTL for getting the foreign currency of 9,900 rupees. In this case, he is buying the foreign currency, he is buying US dollars. The amount which he is paying is 7.4 lakhs. Now we have to see whether RBI reference rate is available because we have to see the actual rate and the RBI reference rate. Now here the custom exchange rate is given to you and bank buying rate is given to you. You can compute the rate by dividing the rupees with the US dollars. That means 7.4 lakhs divided by 9,900 will actually give you the per unit price or per unit value exchange rate of the US dollar to rupees. But in this case, since RBI reference rate is not available, what is available to us is customs exchange rate as well as the bank buying rate. So therefore, we cannot go to the second. That means we cannot go to section rule 32 sub rule 2 clause A first provision. We have to go to the proviso, which says in case RBI reference rate is not available, because one of the currency which is being exchanged is Indian rupees and the RBI reference rate is not available. So we have to go to this proviso. Proviso says RBI reference rate for a currency is not available, then the value will be 1% of the gross amount of Indian rupees provided or received by the person changing the money. Now, in this case, the person is actually giving 7.4 lakh rupees in order to get 9,900 US dollars. So we have to compute 1% of 7.4 lakhs. Okay. That comes out to be 7.4 lakhs into 1%. That comes out to 7,400 rupees. And on that, this will be the value of supply of services or buying or selling of foreign currency. And on that, we have to apply the rate of 18%. Let us see what question provides. Question says the GST rate will be assumed to be 18%. So value of supply of services will be 7,400. And on that, we will apply the 18% rate and we'll compute the GST. Because the gross amount charged, or sorry, gross amount paid for getting the foreign currency was 7.4 lakhs. So in respect of purchase of foreign currency from an authorized dealer, whether GST will be applicable? Yes, GST will be applicable. That we have seen. In fact, the dealers are charging GST, but we have also validated the applicability of GST, which through our discussion. So I told you that yes, GST will be applicable because it is a supply. It is not a transaction in money. Purchase and sale of foreign currency is a supply, and on this GST will be leviable because consideration and business test is being successfully qualified. So this becomes a taxable supply. What will be the value of supply? For that, we'll go to Rule 32(2)(a). That provides us that since RBI reference rate is not available, so the rate of tax, so the value of supply becomes 1% of the gross amount which is being charged for the purchase of US dollars. Now, gross amount which we are paying here is 7.4 lakhs. We are paying rupees 7.4 lakhs for getting 9,900 US dollars. Therefore, we'll take 1% off the gross amount, which is 7.4 lakhs and which comes out to 7,400 rupees. So option B is the correct answer. GST amount which will be payable at the rate of 18% on 7,400 will be 1,332 rupees. So this option B is the correct option. Other options which say the value will be 7,450, that means 1% of the 1% of the bank rate which is being charged, because our authorized dealer have actually charged 7,400, but the bank buying rate was 7,450. Then 5,200 value has been taken. Some other method has been applied, but that is not correct. GST on transactions below US dollar 10,000 is specifically exempted, so no GST will be applicable. This is again wrong. So correct is that GST will be applicable. So either option A, B or C will be correct. Now second says the value. Value will be 7,400, which is there in option B. And GST amount will be applicable at the rate of 18%, which is again given in option B. So correct option is option B, which says the GST amount will be 1,332. Yes, Ansha, you are right. The option B is the correct option. In fact, for next question, I would wait for your answers also. This time I told you the answer, but for next question or next MCQs, I will wait for your answers. If in case you have understood the provision, you yourself should come up with the right answer. Okay. And in fact, Jyoti is asking for MCQ. We have to write explanation in this paper. No, we do not have to write any explanation, Jyoti. For MCQs, these explanations are provided only for your reference so that you can understand the provision. Even if you do not attend the class, you should be able to understand on what basis the answer has been computed. But in examination, you need not write any reason. That will save your time. In fact, during the beginning of the session, I told you that this will actually save your time on when you are answering the MCQs. And this saved time you can utilize for answering the descriptive questions. You have to just compute the answer and mark the correct option for the MCQs. And 40% of the paper comprises of MCQ, which is quite a big portion. So that will help you in scoring very good in this paper. So I hope this first MCQ on GST is clear to you all. Please let me know through your comments that if in case you have any doubt in MCQ 1. Because with this, we'll move to next MCQ. And for this, the information which is given to us is in issue 1 itself. It says that now we'll read issue 1 from where we had left it earlier. That was during the last overseas visit of senior vice president, the company received export order for specified type of garments for which yarn was required to be imported. So company has got some export order and for which it has to purchase certain yarn. So special type of yarn has to be purchased and it has to be imported. It cannot be procured locally. So they have to import it. Now, what company did? Company imported that special yarn. This is a spelling mistake here. So it is actually yarn from Germany for manufacture of garments. Now, there was no transaction value available for such yarn. Just now we had seen that in case of GST, the assessable value is the transaction value. is the price paid or payable for a particular transaction. And in case the transaction value cannot be accepted, then we go to rules. And for this particular purpose, purchase of foreign currency, we saw that yes, we have to see the valuation rules because there is a specific valuation rule which is applicable to purchase or sale of foreign currency. And reason is that you cannot take the entire transaction value in case of purchase of foreign currency or sale of foreign currency because that does not represent the value of supply of service. Value of supply of service is only a part of that consideration. So for that, we have to go to the valuation rules because that has to be determined through valuation rules. Now, similar is the case for the customs law also. Under customs law, the assessable value is the transaction value of the goods which are being imported in case of import of goods. However, where the transaction value is not available or transaction value cannot be accepted because the price is not the sole consideration or it is transaction is between related parties. Same conditions are there for GST, same are there for the customs also. Then in that case, the transaction value of identical goods under customs has to be considered. Now, what is the transaction value of identical goods and under what cases the transaction value of identical goods under customs has to be considered? This is provided as per Rule 4. And we'll first of all go through the relevant provisions of the customs law. First of all, what are identical goods and how Rule 4 will be applied. In what cases Rule 4 can be applied. Then we will go to the MCQ which is there in relation to such issue. So the situation is that since transaction value is not available, we have to go to the valuation rules. That is customs valuation, customs valuation determination of value of imported goods rules 2007. And here we have to see that Rule 3 says that in case the transaction value cannot be accepted, then we have to go to the rules and we have to apply the rules sequentially. So these customs valuation rules have to be applied sequentially. First one is the transaction value of identical goods. In case you do not have a transaction value for your goods which you are importing, then you have to go to the transaction value of the identical goods. That means the goods which are exactly identical to the goods being purchased. Now, this is not the only criteria to determine that whether these goods are identical or not. We have to go to the definition to exactly find out what are identical goods. In case the transaction value of identical goods cannot be taken, then you have to go to Rule 5, that is transaction value of similar goods. Because similar goods have some relaxations, then the identical goods, they are similar, but they cannot be said to be identical as the term suggests. But then a specific definition for similar goods is also there. If that can also not be accepted, then we have to go to the deductive value, computed value. There we have a specific procedure that how we have to, which all costs we have to deduct. And we have to arrive at the transaction, at the value for these goods. And then computed value, then we have the residual method. So all these rules have to be applied sequentially. But in our case, since the transaction value of identical goods has been taken and the question does not have any information that the value was not available. So we'll assume that value of identical goods must be available. But we have to see under what conditions we have to take the value of identical goods as our assessable value. For that, first of all, let us see what is an identical goods. I'm taking you to Rule 2, which explains the definition of which contains the definition of identical goods. Identical goods means imported goods which are same in all respects, because as the word suggests, they are identical in nature. So they should be same in all respects, like physical characteristics, quality and reputation as the goods being valued, except for minor differences in appearance that do not affect the value of the goods. So for example, if we say that if we are comparing two apples, then their physical appearance can be a bit different, but yes, their physical characteristics and quality of those apples should be also be exactly same. Their reputation for valuation purpose. So in case we have to see their pricing, that at what value they can be sold, that should also be exactly similar. Then only that value can be accepted. So only thing is that particular transaction value is not there. But that kind of goods, if before that time or nearest to that particular point of time, that good has been imported, then we take that value. So it should be same in all respects: physical characteristics, quality, and reputation for pricing. Then it should be produced in the same country in which the goods being valued. So if we are importing goods from US and we do not have the transaction value, then we have to take the identical goods which are being produced in United States only. We cannot take identical goods from some other country. That is the basic condition. So in case you do not have the same product which is being manufactured from that country, the value of that good is not available. You cannot take the transaction value of identical goods. You have to go to the next step, that is transaction value of the similar goods has to be taken. So same country in which the goods being valued are produced, that same country's product has to be taken. Identical product, which is same in all respects, that particular goods have to be taken. These should be produced by the same person who produced the goods, or in case where no such goods are available, then goods produced by a different person. So this relaxation is available. Goods should be produced in the same country. Goods should be produced either by the same person, or where same person is not available, then a different producer can be taken, or different manufacturer, goods of different manufacturer can be taken, but goods should be identical in all respects, like in their characteristics, in their pricing, then in their quality, they should be identical goods. But they shall not include imported goods where engineering, development work, or artwork, design work, plan, or sketch undertaken in India were completed directly or indirectly by the buyer on these imported goods free of charge or at a reduced cost for use in connection with production and sales for export of these imported goods. So this is what identical goods is. Now, when we are applying the definition, when we are applying the transaction value of identical goods, or we are accepting the transaction value of identical goods as our assessable value because we do not have the transaction value for our own goods, then in that case, Rule 4, Subrule 1, Clause B provides a specific condition, or it imposes a specific condition that in applying this rule, the transaction value of identical goods in a sale at same commercial level and in substantially same quantity as the goods being valued shall be used to determine the value of imported goods. Now, what does it actually mean? It means that the transaction value of identical goods will be accepted only when these identical goods have been sold at the same commercial level. Now, same commercial level means that means if the goods which are being exported to our country from some other country, then the regulations or restrictions on that export are same. That the countries, because we are saying that they should be from the same country. These goods should be imported from the same country. They should be produced in the same country. So their commercial level, it should be at the same commercial level. The level at which the producer is operating, then whatever benefits, whatever disadvantages, both they should be same. So the commercial level at which the two producers are, the goods have been procured from two different producers, in case they have been procured from two different producers, or if they are from the same person who is producing them, then the commercial level should be same. Similarly, in the same quantity. So if we are producing if we are importing the 100 units of a particular product, and we do not have transaction value, we have to see the transaction value of identical goods, then approximately same kind of value or units or quantity should be imported. If we are taking the transaction value of identical goods, then those goods should also be imported in approximately a similar or substantially same quantity. It should not be a huge variation. Like if we are importing 100 units and we are seeing the transaction value of the goods which are being imported in 1000 units, because there can be a quantity discount which is being provided by the supplier or by the exporter. So in that case, that value cannot be accepted here. That discount will not be able to account for. So substantially same quantity and same commercial level is there. In case that is not there, in case the commercial level is different, or like I told you that they are not being imported in same quantity, they are being imported in huge quantity, then discount can be there. So those factors have to be accounted for, those adjustments have to be made, and then we can get the whatever value we get after those adjustments, which we have made for a different commercial level or for a different quantity being imported, then that adjustment has to be carried out in the value, and that value will be actually accepted as transaction value of identical goods. Substantially same quantity, Mansha, like I gave you the example that if I am importing 100 units of a particular product from country X, and whatever value I am taking for the identical goods, then those identical goods are being imported in a quantity of 1,000 or in a quantity of 500 units, then that there can be a difference in their pricing because of the huge bulk purchase. Because somebody is purchasing in a huge quantity, he might be getting some discount, which I am not getting. And if I take their transaction value, then the two might not be comparable. So they should be in substantially same quantity. If I am importing 100 units, we can take 110, 120, that would be acceptable. But if there is huge difference, which can create a difference in their pricing, then that value cannot be, that quantity cannot be taken. That transaction value will not be able to accept. Identical goods, same quantity. Mansha has given me the option, correct option also. In fact, I will request all of you to give the correct option for which MCQ. It is MCQ number 5. So let us read the MCQ. In the meantime, all of you, please give me the correct answer. I will wait for your answers. Which of the following statements is correct in relation to import of yarn for which transaction value of identical goods was considered under customs? Now we have understood the concept of transaction value and when the transaction value for identical goods can be accepted or considered and when adjustments have to be made. Now regarding this, we have been given 4 statements. We have to see which one is correct in this regard. The transaction value of identical goods in a sale at any commercial level and in substantially the same quantity as the goods being valued shall be used to determine the value of imported goods. This is the first statement. I will read out all 4 statements and then I will wait for your answers. The transaction value of identical goods in a sale at same commercial level and in any quantity as the goods being valued shall be used to determine the value of imported goods. The transaction value of identical goods in a sale at same commercial level and in substantially the same quantity as the goods being valued shall be used to determine the value of imported goods. The transaction value of identical goods in a sale at any commercial level and in any quantity as the goods being valued shall be used to determine the value of imported goods. So yes, I am getting correct answers from all of you. Munish, you are also right. The transaction value of identical goods in a sale at same commercial level and in substantially the same quantity as the goods being valued shall be used to determine the value of imported goods. Okay, so this is the correct answer. Now, this is not being highlighted. It's not highlighted. It's not working. So option C is the correct answer. Okay. So all of you are right who have given the correct answers that option C is correct because the transaction value of identical goods can only be accepted as the transaction value for our goods when they have been imported. These identical goods have been imported at the same commercial level and in the same quantity as the goods being valued. Now we come to the next question. In fact, read out the question first, then we will see the facts of the case and then we'll see what answer would be there. Mr. Q, before accepting the appointment as a director, discussed with the company about the implications of GST on his appointment and emoluments. Explain if services provided by the directors are under the ambit of the GST law. Now, what Mr. Q is actually, what type of a director Mr. Q is? You have already seen this issue earlier also when Shraddha ma'am was discussing regarding the law provisions or issues regarding pertaining to subject of law. We'll just go through the last sentence of this issue. WTL proposes to appoint Q as an independent director who is already serving as managing director in one company and independent director in 3 other listed entities. Now, WTL wants to appoint Q as an independent director. If Q is appointed as an independent director, then Q wants to know that what will be GST implications on him under GST law. So, all of you, if you have any idea regarding the answer, in very short, in 2-3 bullet points, you can give me the answer regarding this question, that what are the GST implications on any director which is being appointed as an independent director for the company. I'm waiting for your answers. Okay. So before that, I will take a query of Mansha. Mansha is asking, when will be the session on statutory update for IBT be held? Okay, Mansha, whatever live learning classes we had held for the IBT, after the when the classes were being convened in the month of January, approximately after mid of January, these statutory update had been conducted. And in fact, if you want to get it repeated, there is a possibility in BOS for success sessions, which we might be holding during the month of March or April. We'll be taking these statutory update for final. Okay, so then there you can see these, you can refer these statutory updates for the indirect tax laws. Okay, Munish is telling setting fee received by Mr. Q will be charged on RCM basis. Okay, so Munish, you have come up with the answer. Let us see the provision and then I will tell you whether this is right or not. In fact, I am expecting more answers from others, so I don't want to tell whether it is correct or not. In the meantime, let us go through the provision. Taxability of remuneration paid to the director. I will try to cover it quickly because after that we have to see the one question which is there on Ind AS also. So in case these services, because directors are providing services to the company and there is a entry in the reverse charge notification number 13 by 2017, which provides that any services provided by a director to a company shall be liable to tax under reverse charge mechanism by the company. Now that is very important. One thing which is very important is that the services must be provided by the director in the capacity of the director or in the professional capacity. He should not be an employee of the company. If this director is an employee of the company, then the situation will become different. We will see it. But if this director is not an employee of the company, then in that case, those services will be taxable under reverse charge, like this diagram provides you. Now, a director who is not an employee or an independent director. Now, Mr. Q here is an independent director, and the independent director can never be an employee of the company as per the provisions of the Company Act. Okay, so this has already been discussed regarding this particular issue. Shraddha ma'am has already explained you. So, independent director not being an employee of the company or any other employee who is not an employee of the company, then any services which he is providing to the company, then that means he is providing in the capacity of the director only. That will be liable to GST and tax will be paid by the company. So what is the situation if this director is an employee of the company? In that case, this director, the services provided by this director will be services provided by an employee to employer. Then when we hear these words, services by employee to employer, the immediate thing which comes to our mind is the Schedule 3. Schedule 3 says that any services provided by employee to employer will be covered under Schedule 3 or they will not be considered as supply of goods or supply of services. So if the director is an employee of the company, then services will become a non-supply. Services will be considered as neither supply of goods nor supply of services, and therefore they will not be considered as supply per se. Now, if they are not supply, they will not be liable to GST and no GST will be payable. So the question of forward charge, reverse charge will not be there, and this services provided by that particular director will not be subject to GST. Okay, so Mansha is saying that the class was to be held in February month. Mansha, I have to see and you can see the recorded lectures. I think a statutory update class is there, but don't worry, BOS for success session is definitely going to have the statutory update discussion. So you can see the BOS for success session. I will try to cover the significant amendments in BOS for success session, which will be held, I think in the coming month or maybe after that it will be held. Okay. Now, since the independent director is not an employee, So his services will be taxable. Any director who is an employee, his services will not be taxable because he is not a supplier. But since in our case, Mr. Q is an independent director as per the information given. Mr. Q, he has to be appointed as an independent director. So he cannot be an employee of the company. Now, since he is not an employee, he is providing services in the capacity of a director. And therefore, he will be, in case he is appointed as an independent director, then his services will be taxable under GST. GST on the same will be payable by the company. So let us see the answer. Just have a look at the answer. That is, services provided by the independent directors who are not the employees, they are clearly outside the scope of Schedule 3. Outside Schedule 3 means they are supplied. Then we have to see whether GST is leviable. Yes, GST is leviable on this particular transaction. And it will be payable under reverse charge by the recipient, that is company, that is WTL. So in this on whatever services Mr. Q is providing to the company, to WTL, WTL has to pay tax because the Mr. Q is a director of the company. He is not an employee of the company. So this is actually the taxability of the services provided by independent director to the company. Now, with this, we come into the discussion with regard to GST provisions and the issues which are relating to GST. We have discussed all three questions, 2 MCQs and 1 descriptive question. The last issue which is left is, but it pertains to financial reporting, and that will be taken by Shilpa ma'am. She is already there in the session. So ma'am, over to you. Now you can carry on the session.
Thank you. Thank you, Shefali. And students, hope you found this in-depth discussion of GST very useful, and it will really help you if you just gain these insights from the sessions. So let's move on to Shefali, just remove your sharing so that I can. Okay, thank you. Okay, so students, let me share my screen. So students, hope you are able to see. Hope you are able to see. Okay. Now let's move on. So first let us read the issue. Then we'll discuss the relevant provision based on which we have to answer this issue, and then we'll see the answer. Okay. This is the way we'll be moving on. So first let us read this issue. Issue is for this financial reporting portion. Issue 5 is relevant for you. Ava Private Limited was acquired by WTL, and the same was accounted as a business combination as per Ind AS 103. However, there was an existing share-based scheme in Ava Private Limited with a vesting condition for 4 years, in which 3 years had already lapsed at the date of acquisition. WTL agreed to replace the existing award for the employees of the acquired entity. The fair value of the option under share-based payment scheme on acquisition date was rupees 1200, while the fair value of option replacing the existing scheme was rupees 1500. Also, only 1 year was left for vesting after the acquisition. So this is the issue. So students, first of all, let us see, because this is a question of Ind AS 103, and Ind AS 103 deals with business combinations. So first of all, we have to see who is the acquirer and who is the acquiree. Acquirer is the entity which takes over the business of another entity. By stating takeover, it doesn't mean that you are merging your business. It may appear that they are acquiring the control of that entity by investing in the equity shares of that particular entity. However, this portion has not been given in this issue, so we are not going in depth for that, but we are believing that it is a question of Ind AS 103 business combination, where WTL is the acquirer who is now having control over Ava Private Limited, which is acquiring. When we are acquiring any entity, we are acquiring the assets and liability. We have to later on, after acquiring, after business combination, we have to prepare a consolidated balance sheet. And consolidated balance sheet means we have to take over. And sorry, first of all, let's see what we do when we are combining the business. When we are combining the business, we are acquiring particular entity, we have to pay a purchase consideration, and that purchase consideration is in the form of equity shares or investment in their equity shares. But for acquiring that control, we have to value at what value we are acquiring that entity. And for valuation of that entity, we have to take the assets and liabilities of that entity. And as per Ind AS 103, assets and liabilities of acquiring entity are taken over by acquirer entity at fair value. At fair value. And sometimes it may happen that when you are acquiring the assets and liabilities, entity may have certain liabilities which they have not recorded, but they are identified at the time of acquisition. Okay, and there may be some other liabilities and assets also which are not measured as per Ind AS 103, they are measured as per different standards or in a different form. But when you are acquiring those assets and liabilities, you have to measure them again as per fair value, and for fair value or as per relevant standard. As per relevant also, standard also, there may be for different items, there are different provisions. Here, now let us see what is happening in this particular scenario. In this particular scenario, Ava Private Limited has issued certain share-based scheme, was having some share-based scheme for its employees. And as per their share-based scheme, the vesting condition was of 4 years. Out of those 4 years, 3 years have already been lapsed. It means 3 years have been passed and only 1 year has been left for those share-based scheme to be vested. So employees are having those share-based payments, whatever say we can say share-based shares or grant, and on awards, and those awards will be materialized only on vesting. And for vesting, there are still 1 more year is left for vesting. Okay. Now, when W2L is acquiring Aver Limited, they are taking over the assets and liabilities of Aver Limited. In those assets and liabilities, they are also taking over that they found that Aver Limited has is having some share-based scheme for its employees, and employees are having that. This is there. So now they have to acquire debt also. So there's 2 ways of acquiring it. They take it as it is. Whatever the valuation is that they take it at the value. Otherwise, they can take that by replacing. They can, instead of those existing share-based scheme, they can issue or they can introduce their new share-based scheme, which is as per WTL Limited's terms of agreement. Okay. So in this case, what is to be done? What will be the accounting under this acquisition under Ind AS 103? We have to see that. So this is basically the background. We are having 3 informations here. First is that this accounting is to be done at the time of acquisition. Out of this, second information is that the vesting period, total vesting period is 4 years. Out of this 4 years, 3 years has been lapsed. Third information is the fair value. Third information is that the acquiring entity has replaced the share-based scheme of acquiring entity with their own share-based scheme. Fourth information is the fair value of the share-based scheme of Ava Limited is 1200, and when we are replacing it, then what is the fair value? It is 1500. Okay. Students, hope you are able to see my screen. Okay, this is there. Now we'll move on to the relevant provision. For relevant provision, I have opened Ind AS 103. First of all, because this is a question of Ind AS 103 business combination, so we have to see what is to be done. Which provision of 103 deals with such type of share-based scheme? So I have opened the study material. In study material, this is page number, your new course study material, page number 12.66 of module 4. This chapter is in your module 4, 12.66 and para 10.10, which talks about acquirer share-based payment awards, exchange for awards held by the acquiree employees. Okay. Now, let us read these provisions and understand each step of it. An acquirer may exchange his share-based payment awards for award held by employees of the acquiree. In such a case, when you are exchanging, when the acquirer is exchanging such share-based payment awards, they are termed as replacement awards. So hereafter, I'll be talking in the term of replacement awards. So the above share-based payment awards will include vested and unvested shares. Here the case is 3 years is vested and 1 year is unvested. Exchange of share options or other share-based payment awards in conjunction with a business combination are accounted for as modification of share-based payment awards in accordance with Ind AS 102 share-based payment. So what is the key here is that though we are talking about Ind AS 103, we are reading Ind AS 103, but for this particular share-based payment scheme, Ind AS 103 is saying we have to do the accounting based on Ind AS 102. And what provision of Ind AS 102 is to be applied in such a scenario is modification of share-based schemes. When acquirer entity is giving replacement awards in return of the as a substitute of the share-based payment awards of the employee entity or so the acquiring entity, then at that case they're saying valuation is to be done and accounting is to be done as per Ind AS 102 share-based payment. Fine. So we have to move to share-based payment. However, we have, for the convenience of the students who are studying this chapter, we have reproduced provisions of 102 here also. So instead of going to 102, I'm reading it here. However, if you wish to go through Ind AS 102, then chapter 7, which is in your module 2, unit 2, that is your, unit 3. Unit 3 is on Ind AS 102 and there 7.98 deals with modification, cancellation and settlement. As we have read in Ind AS 103 that this is the case of modification. So you can study from Ind AS 102 also, which is given in your module 2, chapter 7, unit 3 at page number 7.98. This particular paragraph section 3.10 deals with modification of share-based schemes, and this will also be relevant in case of your Ind AS 103 business combination. However, I'm just going through your 103 only. Okay. So because this is a case where at the time of acquisition, this replacement award is taking place. Okay. So we have to see the accounting in light of Ind AS 103 as well. Now, if the acquirer replaces I'm with this fourth bullet, I'm just selecting this because I'm not having pen facility here. So I'm just selecting this so that you can concentrate which particular paragraph I am reading. If the acquirer replaces the acquiree awards, either all or portion of the market-based measure of the acquirer's replacement award shall be included in measuring the consideration transferred in the business combination. Here, market-based measure means that award will be remeasured on the acquisition date as per the requirements of Ind AS 102. We are having the fair value of the original awards. We are also having the fair value of the replaced awards. However, we have to remeasure the awards, the replaced awards, and we have to bifurcate what portion is to be considered as part of purchase consideration and what portion is to be considered as post-business combination expense, and that is to be expensed in your financial statements. So the value is to be bifurcated into two parts. One part which will be pre-combination period, that will form part of the measurement of that particular award will form part of the purchase consideration, and the later part will be post-combination, and post-combination will, as the accounting which is done for Ind AS 102 is that for share-based payment scheme is that it will be considered as your employee cost and will be charged to your profit and loss statement. Okay. So again, I'm reading this particular bullet. If the acquirer replaces the acquiree awards, either all or portion of the market-based measure of the acquirer's replacement award shall be included in measuring the consideration. Consideration here means purchase consideration transferred in the business combination. Market-based measure means that awards will be remeasured on the acquisition date as per the requirements of Ind AS 102. In situation in which acquiree awards would expire as a consequence of business combination, and if the acquirer replaces those awards when it is not obliged to do so. All the market-based measure of the replacement award shall be recognized as remuneration cost in the post-combination statement. See, first paragraph is saying, this particular bullet is saying pre-combination portion will be considered as part of consideration, and this paragraph is saying the post-combination period will post-combination value or measure will be considered as your employee cost, a remuneration cost, and it will be charged in your financial statements, in your statement of profit and loss. Okay. Now, how to measure that? To determine the portion of replacement award that is part of the consideration transferred for the acquiree and the portion that is remuneration for post-combination service, the acquirer shall measure both the replacement awards granted by the acquirer and the acquiree awards as of the acquisition date in accordance with India's 102. See, 103 is also connecting you or referring you to India's 102. But 102 provisions are already mentioned here. I'm just going through the relevant accounting because we are exceeding time. It is almost 8:53 and we have to close it early. So students, I'm just moving to the accounting portion. The portion of the replacement award attributable to pre-combination period is the market-based measure of the acquiree award. Acquiree award is the original award. Okay. So for this pre-combination service, we are taking the portion of the replacement award attributable to the pre-combination service is the market-based measure. Market-based measure means fair value. Fair value of the acquiree award means the original award. So fair value of the original award multiplied by the ratio of the portion of the vesting period completed to the greater of the total vesting period or the original vesting period of the acquiree award. Here in the scenario, if we go through the scenario, we'll find that vesting period of the original award is given, but no change in the vesting period has been mentioned for the replaced award. It means we are believing, and it is also mentioned also only 1 year was left for vesting after the acquisition. It means for replacement award also the vesting period, unvested period is 1 year only. Okay. So in such a situation, the vesting period is common for both the awards. So there is no question of greater of the total vesting period, okay, of the original or the replaced award. So what we are doing, 3 years already lapsed and 4 years is the total vesting period. So we are dividing the fair value of the original award into 3 by 4. 3 is the unvested, so 3 is the vested already lapsed period and 4 is the total vesting period. So again, we see this market-based measure of the acquiree award multiplied by market-based measure of the acquiree award multiplied by the ratio of the portion of the vesting period completed means lapsed to the greater of the total vesting period or the original vesting period. In this case, total vesting period or the original vesting period is same. So it is divided by 4 only. That is 4 years. Total vesting period is 4 years. And the period which has been completed is 3 years. So the vesting period is the period during which all the specified vest. So this you are aware of. Now I believe you are aware of this provision. Okay. Now the portion of non-vested replacement award attributable to post-combination period, we have to find both the things. So what is first pre-combination service period is to be considered in the as a part of purchase consideration, and post-combination also we have to compute because that will be part of your statement of profit and loss. So for post-combination period, there are two things. As remuneration cost of the post-combination period equals to the total market measure of the replacement award less the amount attributed to the pre-combination period. These are the relevant information which is required for solving that particular issue. So first we have to compute the origin. We have to find out what is the fair value of the original award, then what vesting period has been lapsed or completed, and what is the total vesting period. By this formula, we'll be calculating the pre-combination service award value measurement, and out of then how to compute the post-combination. We have to now, in this case, for post-combination service period, what we have to take the fair value of the replaced award, not the original award. For computation of pre-combination, we are taking the original values or fair value of the original award. However, for post-combination service period, we'll be taking the fair value of the replacement award. And from that fair value of the replacement award, we'll be reducing whatever we have, the component of purchase consideration, which we have attributed to purchase consideration, that will be reducing it. We'll find the post-combination period. Now, let's move on to the question here. Which is the original award? The fair value of the original award is 1200. The fair value of the option under share on acquisition date. So this is on acquisition date, you are having the original award, which the fair value is 1200. So 1200 into 3, which is your vesting period completed, divided by total vesting period, which is 4 years. So let us see the solution also for this simultaneously, so that we can go through this answer. Okay, so your fair value of the original award is 1200 divided by 4 years multiplied by 3 years, we get the amount rupees 900, which forms part of the purchase consideration as per business code Ind AS 103 and also as per Ind AS 102 also. Okay, so now what is left is your post combination period. So what we discussed was 1500 is your fair value of the replaced award. So fair value of replaced award minus what we have already transferred to as an element of purchase consideration is 900. So 1500 minus 900, we get the post combination service period, and which is to be charged to your profit and loss as your remuneration to employees, or we can say employee cost. Okay, there are two ways of solving this. First, what we have done, this is simple. This is to be done in both the cases. In both the alternative presentation of the solution, we have to use this formula, which is fair value of the original award into your period of vesting period, which has been lapsed, divided by total vesting period. You'll get 900 rupees. In both the cases, you have to do this. After that, either you first find out from the original award what is the difference of the fair value of this, what difference of fair value of the replace award minus the fair value of the original award, or simply you do it the fair value of replacement award minus this element which has been attributed to purchase consideration. In both cases, you will find the same answer. What they have done here in the first way, first we have found out 1500 and 1200 ka difference, that is 300 rupees, and later on the 300 which we have not used out of this 1200. Are you getting my point? From 1500 to 1200, this 300 not used for purchase consideration, and in this 1200 also we have not used 300. That why we have used only 900. So 300 which has been left, that has also been considered for post combination period. So this total 600. Otherwise, we can simply do 1500 minus 900. We get 600 as 1500 minus 900. We get 600, which will be recorded as an employee expense in the books. So students, I hope this is clear to you. I'm just now stop sharing my screen and I'm going through the queries which students have posted. Let me answer that. Just a clarification on final paper 6. Arun GA is asking. Arun G is asking, just a clarification on final paper 6 for MCQ questions. Should we mark answers only in OMR sheets, or do we need to write explanations for MCQs as shown in case studies? See, students, the explanation which we have shown in the case studies is only for your understanding. Right now, you are preparing for this paper. And when you are preparing for this paper, you should know where whatever you are thinking or whatever the provisions which you are applying, that is correct or not. For cross-checking of that, we have given the explanation of MCQs, answers of MCQs. However, in OMR sheet, there is no provision of giving the reasons. It is only marking that you have to do. You have to simply dark the correct answer, the correct option. So there is no space to give the reason. So they are not required to give the reason. Even in the answer sheet of descriptive part, you are not supposed to write the reasons for the answers of MCQs. So don't waste your time in the examination for writing the reasoning. That is not going to be evaluated, and there are no marks for those reasonings. So unnecessary using that time is is waste of time. In fact, writing the reasoning will be waste of time. First thing. Second is that the time, because this is the benefit of this manner of assessment where you are having MCQ plus your descriptive, 40% MCQ and 60% descriptive, is that because this is an integrated business solution and you have to combine these reading of other core papers and self-paced modules set A and set B. So you are having more work. So for passing every paper, you require 40%, and an aggregate, you require 50%. So if 40% is MCQ and we are providing you only to mark it in your OMR sheet, so the benefit or the saving of time in writing the reasoning and in computing it, that saving of time can be used in your descriptive part, where we are giving the multifaceted case scenarios will be there, which involves integration of different subjects. So there you may require more time. So this saving of time of filling the OMR sheets without reasoning will be utilized in your descriptive part. So use that. Okay. Okay, Mansa, ma'am, I have a query related to India's 110. May I ask now, Mansa, see, if you are having any query related to India's 110, please post me to my different portal. Right now, we are dealing with IBS case studies, and other students may not find it relevant. Okay, but I'll be replying you. Just please may post your query to my ask your portal, BOS mobile portal. Ask your query, and there I'll be replying you. Okay, one more query was there which I missed it out. Ma'am, our faculty CA Arun sir has said that a session will be held in February month, but this month there wasn't any session for IDT.
IDT, ma'am.
Achha, okay. You replied that, Shifani?
I've answered it.
Achha, you have already answered it? Okay. So, students, in case you have any other query, we can answer that. I'm waiting for any other queries. Otherwise, we can wind up the session. I'm still just checking in case we'll give 1 minute, and in case any student have any other query relating to this India's portion, we can answer it. We can address that. Okay.
I think, ma'am, you have taken a very explanatory session. So students are clear with everything. In fact, Mansha has a query she can post through BOS Knowledge Portal. This BOS app, she can post it to ask.
Mansa, do it there. Maybe that because of certain other works, I may have not replied your query earlier. In case you have already posted, but I'll be definitely replying it. Okay. But this is not a platform because students may not, other participants may not be aware of that particular issue or question, so they may get confused. So let's not take it up here on this platform.
Yes,
okay, students. Shifani, we can wind up because I'm not finding any more queries on this.
Okay, ma'am. Okay. Thank you, students. Thank you, ma'am, for this wonderful session. And with this, we come to an end of this session. All the issues have been discussed sufficiently. And now I think you are clear with the way how you have to approach the case studies. We'll come up with some more case studies in subsequent sessions. And thank you so much for the patient listening. Thank you.
Thank you. Thank you, everyone, and have a good day. Bye.